Welcome to the much awaited and much requested corporate accounting marathon. So this is your group 2 of your CMA exams, CMA intermediate exams. Okay, it's a easy paper. Okay, there are limited chapters. Okay, we have one chapter on shares and debentures. There is a chapter on preparation of financial statement. There is a cash flow statement chapter, and there is accounting standards, and then there is banking, electricity, and insurance companies. So we'll try to cover the major areas and important concepts and important questions. Same thing what we have done in the financial accounting marathon, the same procedure is going to be followed. That is, from December 2023, all the past examination papers and the model test papers are going to be discussed. Clear? So let's start with our chapter number 1, that is share capital and shares and debentures. So let's start with share capital right now. You have first, in share capital, what is authorized capital? Authorized capital means maximum capital that can be issued by the company. For example, if I tell 1 lakh shares of 10 each. Issued capital. Issued capital is out of the authorized capital. How much capital has been issued? That is how much capital the company requires right now that they would have issued. 60,000 shares of 10 each. Now subscribed capital, whatever we have issued, has public shown interest in that? Okay, shares taken out of issued capital, that is 58,000 shares of 10 each. Now whatever I have subscribed, it doesn't mean that on day 1 only I will ask for the money. So how much money I have asked as a company? Called up capital, amount asked out of the subscribed capital. And finally we go into paid up capital. What is paid up capital? Whatever I have asked. Has the shareholder promptly made the payment? No, shareholder has not paid everything. Then that is paid up capital, amount paid out of the called up capital, and whatever they usually don't pay, we call it as calls in arrears. We call it as calls in arrears. Clear? So now issue of shares. When we go into issue of shares, there are things that you have to remember. It can be issued at par. Issued at par means what? It is face value 10 and issued at 10. But whenever the share is issued at par, that means at face value, it's called as issued at par. Now issued at premium. Issued at premium means what? You have issued it at a higher price more than the face value. Example, if face value is 10 and you've issued it at 12. Issued at discount. Issued at discount means what? Issued at lower than face value, which is prohibited, and it is allowed only in one case. When it is sweat equity shares. Now let's go into the journal entry for share issue. When it is issued at par, okay, when it is issued at par, we will discuss. There is application stage, allotment stage, and call stage. Now when we are at the application stage, okay, what is the situation? Shareholder has to show interest and pay the application money. Bank account debited because money comes in, asset increases, to share application account. A temporary account is kept. Now next entry is usually share application money to share capital, but we pass this entry only when we are sure that the shares are going to be allotted. If we are not sure that the shares are going to be allotted, then this entry is not going to be there. When is it going to happen? When there is an under subscription. Okay, under subscription, what happens? Under subscription is the Companies Act has told limit is 90%. At least 90% of the shares have to be subscribed. If you don't reach the 90% shares, then what you have to do? You have to refund the money. When you are refunding the money, it is share application account debited to bank account. Share application account debited to bank account. Clear? That is basically whatever you have done over share application, it's getting reversed and money is going out. Reversal of this particular entry. Clear? Or there is over subscription, that is more shares are subscribed for. If there is over subscription, we reject the excess applications. Okay, if you are rejecting the excess application, you will pass this entry. Or there is something called as pro rata allotment. Pro rata allotment means what? You are trying to satisfy every shareholder, everybody who has given the application money, but you are not going to give them the shares what they have asked for. So excess application amount is adjusted with allotment amount in case of pro rata allotment. It can also be adjusted with call also, but maximum it goes usually till allotment stage. Now, when we are going to allotment and when we are going to call, always there is a due entry and there is a receipt entry. When we are having the due entry, it is share allotment account debited, equity share allotment account debited to share capital. Due entry, that is we are making it due. See, can you see we are passing a due entry over here, due situation over here. That means asset is created for a receivable. When you receive it, bank account debited to equity share allotment account. Now, Same thing for call also, equity share call account or preference share call account debited to share capital, bank account debited to share call. Clear? This much we have to know. This is the basic of share issue. Next we go into if at all shares are issued at premium. If shares are issued at premium at any stage, okay, if it is issued at any stage, it can be issued at any stage premium. It can be, they can tell that application stage only we are collecting the premium, allotment stage we are collecting the premium, or in the call stage we are collecting the premium. But if question is silent, what you will do, it will always be at allotment stage. Clear? Now application stage, if at all you are collecting premium. Now what will you do? Entry number 2. Entry number 1 will be same. Bank account debited to equity share application. You receive the money. But when you're transferring the money to share capital, equity share application account debited to equity share capital, or preference also can be there. The extra amount that is more than face value goes into securities premium account. Okay, allotment or call stage. If you are at the allotment or call stage, share allotment or call account debited, share allotment or call account debited to share capital to securities premium account, to share capital to securities premium account. Is this clear? Yes. Now, once we are done with this, whenever share is issued at premium, right? When you're transferring to share capital at that particular stage, you just transfer it to securities premium. Okay, let's go further. Now we go into calls in arrears. What is calls in arrears? It's an asset, but why is it an asset? Because amount is called up but not paid up. That means we have asked the money, they have not given the money, so it is receivable. So it can be at application stage, it can be at allotment stage and call stage. At application stage, there is no question of calls in arrears because first they have to pay the money, then only they become a part of the story. So application stage, there cannot be calls in arrears. Only in allotment and call stage, there can be. Now due entry. Okay, when you are having the due entry, share allotment or call account debited to share capital. Okay, now received entry you already know. Imagine it is not received. Then you will pass the entry calls in arrears account debited to share allotment or call account. Calls in arrears account debited to share allotment or call account. Now, interest on calls in arrears. Interest on calls in arrears for the company, it's an income because they have to get the money. Maximum is 10%. The maximum interest on calls in arrears is 10%. Now due. Okay. When the interest is due, you have to get the money. Get the money from whom? From the shareholder. So shareholder account debited to interest on calls in arrears. This is the income. So you pass the due entry. When you receive the money, bank account debited because money comes in to shareholder account. The receivable situation is gone. Interest on calls in arrears is an income. It should be transferred to P&L. P&L is credited because it is income. Now calls in advance. When we are going into calls in advance, so now we go into calls in advance. Calls in advance is there, right? It's a liability. Why is it a liability? Because amount paid by the shareholder before even it is called. So before we asked itself, the shareholder has paid the amount. Now due entry. Due entry, you understand this. Okay, share allotment or call account debited to share capital. We ask the money as always. Okay, receipt, bank account debited, whatever you have received. Okay, and the extra amount is there. No, that goes into calls in advance. The extra amount goes into calls in advance. Now 244. Okay, this is the example which we had taken. Now imagine bank account debited to share application to share capital, then share allotment to share capital, bank to share capital. Now see over here in future. Okay, let me just complete this part. In future, calls in advance account debited to share capital whenever the call actually becomes due. Now imagine this fellow has paid early at the allotment stage. So what will we do? Bank account debited 8 only. What we transfer to allotment is only 4, but what we will transfer, the extra amount will go to calls in advance. Now share call account debited to share capital. Next time when we make the due entry, what we will do? This time again we will not get the money. We will directly pass the entry calls in advance account debited to share capital. Clear? Now interest on calls in advance. Okay, it's an expense because we have to pay the interest now. Interest on calls in advance account debited to shareholder. We have to pay, so shareholder is credited because it's a payable situation for us. Now maximum is 12% interest that we can pay. Shareholder account debited to bank account. Shareholder account debited to bank account when you pay the money. Okay. Now expense, what will you do? P&L account debited, expenses transferred to P&L. Next, shares issued for consideration other than cash. So the next topic is shares issued for consideration other than cash. Okay, when shares can be issued for consideration other than cash, that can be asset, okay, to purchase an asset, or you want to make the payment to the promoter, okay, amount paid to the promoter or to the underwriter. Okay, when share is issued to purchase an asset, the first entry will be asset account debited to equity share capital. But if at all the shares are issued at higher value, then it will be to securities premium. Amount paid to promoter. Promoter is giving some contribution, so that for that we are giving him shares. So promoter gives a service. So goodwill account debited to equity share capital to securities premium. If it is underwriter, underwriter's commission has to be paid. So underwriter's commission account debited to equity share capital to securities premium. Next we go into forfeiture. Forfeiture means what? Cancellation of shares. Why are we cancelling shares? We are cancelling shares for non-payment of amount called up. Amount that can be non-paid is allotment amount or the call amount. Now, journal entry for forfeiture of shares when shares are issued at par. Okay, equity share capital account debited. Okay, that is for amount called up. Face value. Amount is called up at what value? Face value. Okay. Called up value will always be in equity share capital, guys, because it is issued at par. To share forfeiture account, amount received. To calls in arrears account, amount not received. Okay, if at all it was not transferred to calls in arrears, it would have been in equity share final call or equity share first call or equity share allotment. Clear? Whatever you have received, it's a profit. It's transferred to share forfeiture account. Whatever is not received, okay, that will be calls in arrears account. That will be in calls in arrears account. Now, share forfeiture, when shares are issued at, excuse me, when shares are issued at premium. Now, premium amount, you have to understand whether it is received or not received. If premium amount is received, do not reverse securities premium. Don't go to bother about securities premium. Equity share capital account debited, amount called up. Okay. Amount called up. Okay. To share forfeiture account, amount received, and calls and arrears, amount not received. Just like what you would have done for face value part or what you would have done when shares are issued at par, that only you are going to do. Okay, but if at all premium is not received, if premium is not received, then reverse the securities premium. If premium is not received, what will you do? You will reverse the securities premium itself. Equity share capital account debited, amount called up. Okay, equity share capital account debited, amount called up. Okay, this will be at face value. Now, securities premium account debited, you are reversing the securities premium. Before we did not receive it, we had already transferred it to securities premium. Now, we are going to remove it from there. Okay, to share forfeiture account, amount received, and to calls and arrears account, amount not received. To calls and arrears account, the amount which is not received. Clear? This much we have to understand when premium is not received. If premium is received, what you will do? You will not reverse the securities premium. Let the amount be in securities premium itself. If premium is received, what you will do? You will not reverse it. You will keep it in securities premium itself. If premium is not received, then you are going to reverse the securities premium. Okay. After forfeiture, there are two options. Either you can reissue the shares or not issue it again. Now, if it is reissue, journal entry, bank account debited. Okay, reissue price, bank account debited, reissue price, share forfeiture account, loss on reissue. If at all the 10 rupee share is now reissued at 8 rupees. Okay, now don't think, sir, it is reissued. No. So we cannot issue it at a discount. We are not issuing it at discount. What is happening over here is 10 rupee face value share is issued at 8 because previous shareholder has already paid some money. So imagine previous person has paid 3 rupees. So his 3 rupees is there. So now we can reissue it at 7 rupees. So 7 plus 3 will become 10. So we are in a position that we can issue it at below face value because previous person has paid some part of the face value. So bank account debited, okay, for the reissue price. Share forfeiture account debited. If at all 10 rupee share is issued at 9 or 8, then the share forfeiture will be debited for 2 rupees, loss on reissue. Now, to equity share capital face value, equity share capital face value. If at all 10 rupees share is issued at 13 rupees, then the extra amount will go to securities premium. Clear? Now transfer to capital reserve. Just remember it has to complete this cycle. Shares forfeited and reissued. Shares which are forfeited and reissued. Balance in share forfeiture account will be transferred to capital reserve. Share forfeiture account debited to capital reserve. So whatever is there in the share forfeiture account, just transfer it to capital reserve. Note, minimum amount of reissue. Okay, minimum amount at what it should be reissued is amount not paid by the previous shareholder. Okay, amount not paid by the previous shareholder should be collected from the next shareholder. So therefore, the minimum amount at which it has to be reissued is, imagine previous person has paid 3. Okay, previous person has not paid 7. So the next person has to at least pay 7. Next person has to at least pay 7. Okay, now note, maximum amount of reissue is no maximum. You can reissue at any price, but minimum amount you have to understand. Now, right issue. Next one is right issue. What is right issue? Right issue is basically shares issued to existing shareholders, usually at a price less than market price. We have issued shares to existing shareholders only, but at a price which is less than market price, market value. Journal entry. Okay, bank account debited to equity share application account. Bank account debited to equity share application account. Now, equity share application to equity share capital to securities premium. Same what we are doing when we issue shares. No, same thing, but usually right issue might not be in parts. It will be fully. So whatever amount is there, fully it will be transferred. Okay, fully it will be transferred at once. The person also will not pay part by part. Now note, right shares optional. Right shares optional. Okay, there is no compulsory that the company has given right shares. You have to purchase those right shares. Okay, now value of right. Value of right, you understand. Price per share before right issue will be given in the question. Price per share before right issue will be given in the question. From that you subtract the price per share after right issue. The price per share which is there after right issue subtracted. But this has to be computed. This is also called as X right price per share, cum right price per share. It's okay. We'll keep it simple. Now, price per share after right issue is number of shares before right issue into market value of shares before right. Okay, plus right shares into right issue price. The whole thing divided by total shares after right issue. Total shares after right issue. So what we have to understand, before plus after, before plus after divided by total shares after. So number of shares before right issue into share price per share before right issue plus right shares into right issue price, the whole thing divided by total shares after right issue. Total shares after right issue. Now next we go into bonus issue. Bonus issue is another part which is there in our syllabus. Now shares issued to existing shareholders for no consideration. We have given shares for free. If there is excess profit, we usually give bonus issue. Journal entry. First, due entry. That is basically us arranging the money. Okay, CRR account debited. That is capital redemption reserve. Second, we take from securities premium. Securities premium account debited. Okay, if that is also not enough, general reserve account debited. Then P&L account debited to bonus to equity shareholders. Clear? First preference, second preference, third preference, and fourth preference. Okay, bonus to equity shareholders. Then what we will do? Bonus to equity shareholders to equity share capital. Now, note, bonus issue only for fully paid up shares. That means if it is partly paid up, you cannot give bonus. You have to make them fully paid, then you can issue the bonus shares. Now, free reserves means what? Reserves that can be used for any purpose. Example are general reserve and P&L. Now, bonus call. Bonus call means what? Some shareholder has paid 8 rupees per share. Now we are going to make the final call. When we are making the final call, we are going to tell them, boss, do one thing, you don't pay the final call. Company has made excessive profit. That profit only will convert it and will make your shares fully paid up. Now, partly paid up shares are converted into fully paid up shares without any money taken from the shareholder. Now, journal entry. First, you make the call. First, what you will do? First, you make the call. Share call account debited to share capital account. Once we make the call, then what we will do? Due. Due entry. Due for what? Bonus. General reserve and P&L. Sir, we are not taking CRR and securities premium here. No, CRR and securities premium can only be used for issue of bonus shares. You can only use it for issue of bonus shares. You can't use it for bonus call. So, general reserve P&L account debited to bonus to equity shareholders. Then bonus to shareholders account debited to share capital. So, basically we are asking the money. taking the profit and keeping it aside. Then profit we are utilizing to convert that share into fully paid up. Now note, capital reserve can be used if it is received in cash or in bank. If at all they tell no capital reserve, is it a free reserve? It is a free reserve if at all amount is received. If they tell us that amount is received, then capital reserve can be considered as free reserve. Now use capital reserve only if required. Use capital reserve only if required. Now sweat equity shares. Shares issued to employees or directors for the efforts put by them. Now employees or directors, they have put some effort and they have taken company to new heights. So shares we are issuing to them. Now for consideration, if you issue shares for consideration, bank account debited, intellectual property account debited to equity share capital. Bank account debited, they are giving us some money, but we are giving them shares of higher value. We are giving them more shares. So intellectual property account debited, that is basically like a goodwill for us or intangible asset for us. Okay, to equity share capital account. Clear? Now for no consideration, intellectual property account debited to equity share capital. They are not giving us anything, so directly we record the intellectual property account debited to equity share capital. If intellectual property that we are getting is less than the face value, then intellectual property account debited. Imagine we are getting 100 rupees from them. We are giving 120 rupees shares. So intellectual property will be 100. Extra we are putting from pocket. So employee expenses account debited to equity share capital. Employee expenses account debited to equity share capital. Is it clear? Yes. Now ESOP. Very important topic here, ESOP. Now, employee stock option plan. Employee stock option plan, option given by company to employees to purchase shares at price less than market price if vesting period is completed. That means this is an option. First of all, it's not a compulsory thing. It's an option given by a company to employees to purchase shares at price lesser than the market price. So if obviously, no, I'm giving you option and telling boss, market price is 50. Can you buy it at 80 rupees? They will not buy only. So we are giving them option to buy it at less than market price. Okay, if vesting period is completed. What is vesting period? The time period which you have to complete to be eligible for that options. Day one only, they might not give you. Important terminologies. First, option, not compulsory. Then vesting period. Vesting period means what? Eligibility period to be completed. Exercise period. Exercise period means period during which options can be exercised after vesting is completed. Period during which the option can be exercised if you complete the vesting period. So if I tell you that 2 years is the vesting period, so if you complete 2 years, then you're eligible for the options. You can exercise them. Exercise period. Now your 2 years are over. Immediately can I tell you that boss, come and purchase the shares? No. Exercise period during which the options can be exercised after vesting period is completed. So they'll give you some time. You completed the eligibility. You're like, okay, 2 years. Okay, boss, take 1 more year. Within this, tell us whether you want the shares or not. Exercise price to be paid by employee. Intrinsic value is actually the price to be paid by the company. Okay, to be treated as expense for the company. Now here what happens? Market price per share minus exercise price. Market price per share minus exercise price. Market price is 50. I gave it to him at 20. That means 30 rupees company has to put, and that is called as intrinsic value. Now let's go into journal entries for ESOP. Okay, during the vesting period, imagine 2 years, 3 years, 4 years, 5 years, whatever may be the vesting period. During the vesting period, every year end, okay, during the vesting period, every year end, what's going to happen is you are going to pass the expense entry. Employee stock option expense account debited, expense is debited, but did you pay that expense today? No, you have not paid that expense. So what will you do? To ESOP outstanding account. Employee stock option expense account debited to ESOP outstanding account, which is a liability. Clear? Now P&L account debited to employee stock option expense account. Every year end this is going to happen. Note, if employee leaves the company, option is lapsed. So on exercise date, okay, on exercise date, what is going to happen? If option is lapsed, you don't worry. For the remaining part, you create provision. If provision is not required, you reverse the provision. Okay, reversing the provision means what? You will do the same thing. Okay, ESOP outstanding account debited to employee stock option expense account. Okay, that should be it. Now, note this, if employee leaves the company, option lapsed. Okay, on exercise date, what will happen? Either the option is exercised or the option is not exercised. If it is not exercised, ESOP outstanding account debited to general reserve. Just transfer the amount to general reserve. What will you do? Transfer the amount to general reserve. So if option lapsed also, you can just transfer the amount to general reserve instead of doing the adjustment. Now if option is exercised, what will you get? Bank account debited, exercise price. Okay, bank account debited, exercise price. ESOP outstanding account debited, intrinsic value. So what they are paying, let's say 20, bank account debited, we are getting money. ESOP outstanding account also debited. ESOP outstanding account debited. This is for the intrinsic value. This is for the intrinsic value. So whatever extra money is there, 30, let's say, that company is going to put, and for that we had already made the provision. So that provision is just reversed. Now to equity share capital, face value, to securities premium, balancing figure. So whatever extra balancing figure is there, that will be transferred to securities premium. Now we go into buyback of equity shares or any securities basically. Now company purchasing their own shares from the market is called as buyback. Company purchasing their own shares from the market is called as buyback. Section 68 of Companies Act 2013. It is again optional for the shareholder. If they want to give the share back, they will give it. Now shares must be fully paid up. Shares must be fully paid up. It cannot be partly paid up shares. Now maximum permissible buyback. Whichever is less you have to choose in this. It is given by section 68. Now in this first thing, share outstanding test. Share outstanding test means what? Whatever number of shares are there, maximum 25% of the shares outstanding can be bought back. This is in quantity. Okay, resource test. Resource test means what? Maximum 25% of paid up share capital plus free reserves plus securities premium. Take the total of that. 25% can be the amount that can be utilized for buyback. Debt equity ratio test, they are telling post buyback. That means after buyback, the debt equity ratio should be at least 2:1. That means if debt is debt and equity, we are saying if debt is 2, equity should be at least 1. That means equity should be at least half of debt. Now, accounting. Let's go into accounting. Okay, due entry. What is the first thing that we have to worry about? Due entry. Equity share capital account debited at face value. Equity share capital account debited at face value. Premium on buyback. You will obviously pay more than face value. You are in fact going to pay more than market price also, because otherwise how will the shareholder be tempted? So premium on buyback account debited, that is an expense. To equity shareholder account. Okay, to equity shareholder account. To gain on buyback account transfer to capital reserve. Understand this due entry. When you are doing buyback, equity share capital account debited at face value. Premium on buyback account debited to equity shareholder. If at all you have any gain on buyback, which is very rare, that you are that you transfer to capital reserve. Payment, equity shareholder account debited to bank. Usually the journal entry will be only till here. Okay. Transfer of premium. Premium, what will you do? Securities premium account debited or free reserves account debited to premium on buyback. Just adjust it with the reserves. Now transfer of gain on buyback account debited to capital reserve, as we already discussed, it has to be transferred. Now creation of CR. Now this Companies Act has told. Now what we have to understand is, when will CRR be created? When will CRR be created? Okay, in case of reduction of preference shares or in buyback of equity shares. So they are told, if at all the share capital reduces, that time you create CRR. Only two cases the share capital is going to reduce. That is preference share redemption or equity share buyback. Now general reserve or P&L account debited to CRR. Remove from free reserves and transfer it to CRR. Face value of equity shares bought back, you transfer it. If at all they have issued some shares, at the time of buyback they have issued some shares, then you can adjust it. Otherwise that is just the face value of equity shares bought back. Clear? Now redemption of preference share. Redemption of preference share, you have to understand one thing. Paying back the money to the shareholder. The next topic that we are going to discuss is redemption of preference shares. Now, paying back the money to preference shareholders. Redemption of preference share is paying back the money to preference shareholders. Now, redemption can be out of fresh issue, or redemption can be out of profits, or redemption can be a combination of both. Now, only again same rule, only fully paid up shares can be redeemed. Now, accounting, issue of shares. Okay, why we are learning the accounting for issue of shares? Now, in case, okay, shares are issued. Same thing, we already studied this bank account debited to share application to equity share capital to securities premium. Now, preference share due. Now, sometimes when we don't have money, what we do it out of fresh issue. So that's why we are learning about what will be the journal entry for fresh issue. No fresh issue, we might not do it in parts. We'll do it in one shot. Okay. Redemption due. When redemption is due, preference share capital account debited. Preference share capital account debited. Premium on redemption of preference shares debited to preference shareholders. Okay. To preference shareholders. This is the due entry. When we pay, what happens? Preference shareholder out of the books, bank account, money also out of the books. Preference shareholder account debited to bank account. So transfer of premium, guys. So P&L account debited to premium on redemption of preference shares. Do not use securities premium. If some companies can use, some companies cannot use. So to avoid that confusion in exam, just use P&L here. Okay. Now issue of debentures. Issue of debentures. CRR creation, same thing. General reserve of P&L account debited to CRR. Clear? Issue of debentures. Now, debentures are debt instruments. That means company borrowing loan from someone. Now, there can be redeemable or irredeemable debentures. Redeemable means what? After a particular period of time, the amount is going to be paid back. Irredeemable means the amount is not going to be paid back. Okay, secured or unsecured debentures. Secured or unsecured means what? After a particular period of time. Okay, so if at all you don't pay also, some security is pledged so that the debenture holder can still recover the money. Unsecured means no security is pledged. Now, no asset is pledged. Convertible or non-convertible. Convertible means debenture can be converted into share. Non-convertible means it cannot be converted into share. Okay, company borrowing loan from debenture holder is debentures. Yes. Accounting for issue. Now, issued in lump sum or issued in installment. If it is issued in installment, just like shares, you will pass application entry, allotment entry, first call entry and final call entry. Okay, issued in lump sum. Bank account debited to debenture application account. Okay, receipt of the amount. Then debenture application account debited to bank account. In case you have to refund excess application, same thing what we used to do for share, pro rata. Now, debenture application account debited, discount on issue of debited. That means if debenture is issued for less than face value, debenture can be issued for less than face value. But equity share cannot be issued for less than face value. So when debenture is issued and it's issued in lump sum, if it's issued in lump sum, the entry will be bank account debited to debenture application account. Okay, receipt of amount. Now, then what will you do? Debenture application account debited to bank, if at all you are refunding in case of excess application, just like shares. Clear? Now, allotment of debenture application account debited, if at all we are issuing it at less than face value, discount on issue of debentures debited to debentures account at face value to securities premium, whatever excess. Now, issued in installment. If it is issued in installment, that means it is issued in parts like application, allotment, first call, second call. Then bank account debited to debenture application to bank, if at all there is refund. Debenture application to debentures. Everywhere use the percentage, same like what we have done for shares. Then debenture allotment account debited, discount on issue of debentures debited to debentures to securities premium. Allotment due entry. Then when we get the allotment money, bank to debenture allotment, then you can have first call, second call, how many ever calls you want. Debenture call to debenture, bank to debenture call. Clear? Now, issue of debentures redeemable at premium. Okay, issue of debentures. If it is redeemable at premium, okay, now understand this, issued at par, okay, issued at par, then it is redeemable at premium, but it was issued at par. Now see this, debenture application account debited to debentures account, that is same. But when we have issued only, we know that we are going to pay higher amount on redemption. So record that loss today itself. Imagine 100 rupees it is issued, but it is going to redeemed at 120, then loss on issue of debentures 20, premium on redemption of debentures 20. This you create today itself. Okay, debenture application 100 to debenture 100. If it is issued at premium, then debenture application, let's say 110 to debenture 100 to securities premium 10. But if this debenture is going to be redeemed at 120, then 20 loss on issue to premium on redemption 20. Clear that? Premium on redemption effect you have to create immediately. Next, if it is issued at discount, that means it is issued at 90, but it will be redeemed at 120. Let's assume like this. So debenture application 90, discount on issue 10 to debenture 100, but it is going to be redeemed at 120. That means 20 rupees more than face value. Loss on issue 20, premium on redemption 20. This effect you have to give. Clear? Now issue of debentures for consideration other than cash. If it is issued for consideration other than cash, let's say for purchase of asset. Asset account debited to vendor. Asset account debited to vendor for purchase of asset. Clear? Asset account debited to vendor account. This one we have to remember. Now if asset is debited to vendor, okay, we have to pay money to vendor. Next what we will do, vendor account debited, we are not giving money, so to debentures, okay, but extra whatever is there, if we are paying, if the debenture is issued at a premium, to securities premium, if it's issued at a discount, to discount, this or discount debited, this or this, only one of them can be there, both cannot be there. Now debenture issued as collateral security. Collateral security means what? I am borrowing money from bank and I am giving debentures to them as security. If at all I don't pay, that time this debenture will get activated and they'll have debentures. Now, first thing is no entry. Just mention as a note below the loan borrowed in the balance sheet. Just mention as a note that loan is secured by issue of debentures. That's it. Now, alternatively, what you can do, debenture suspense account debited to debenture. One dummy entry you are creating. That's a dummy entry just to reflect it in the books. Okay, no impact, but you're bringing it into the books. Now, interest on debentures. Interest on debentures. Interest account debited to bank. Debenture interest account debited to bank. Interest paid. Then P&L account debited to interest. Transfer to P&L. P&L account debited to interest. Transfer to P&L. That's it. Clear? Interest to bank. P&L to interest. Regular interest payment entry. Redemption of debentures. Paying back the money to debenture holders. Redemption of debenture is just giving the money back to the debenture holder. Statutory requirement. Statutory requirement. Okay, DRR, debenture redemption reserve, should be there. And DRR investment, like safe investment, should be there. Debenture redemption reserve, minimum 10% of the debentures outstanding by the end of first year. End of first year only, 10% of the debenture value will be kept in DRR. Okay, DRR investment 15%, minimum 15% of debentures redeemable during the year. Minimum 15% of the debentures redeemable during the year. This and this are not same. Here what will happen at the starting only, first year only you will keep 10% aside. Here what will happen, if I am going to repay the debentures in the upcoming year, that time 15% I will transfer it to debenture redemption reserve investment. Okay, transfer to DRR, P&L account debited to DRR. This is creation of DRR. Then DRR investment account debited to bank. Okay, second one is DRR investment account debited to bank. Whenever you are creating DRR investment, say investment, purchase of investment, that's it. Okay, then what happens? Making the investment by 30th of April. By 30th of April, this investment has to be done. If at all I know this year I have to redeem some debentures, starting of the year only, within 1 month I am going to create DRR investment. Now, when I sell the DRR investment, that am bank account debited to DRR investment, then finally this DRR, debenture redemption reserve, is not required. Transfer it to general reserve. Whatever DRR you created, when the debentures are redeemed, you should transfer that to general reserve. Okay, now non-applicability, creation of DRR. When is DRR not applicable? If it is listed company, it is not applicable. Banking company, it is not applicable. NBFC, it is not applicable. AIFI, All India Financial Institution, it's not applicable. HFC, Housing Financial Corporations also, it is Housing Finance Company also, it is not applicable. For these companies, it's not applicable. So only unlisted companies other than these DRR rules are applicable. Accounting for redemption. Now, when debentures are going to be redeemed, okay, first due entry, then the payment entry. Debenture account debited at face value. Debenture is gone, liability. Premium, if you're paying extra premium on redemption, debited to debenture holders. And when you pay, debenture holders account debited to bank. Done. Now, redemption by conversion into shares. Again, due entry, debentures account debited, premium on redemption. Imagine 100 rupee debenture, I'm going to pay 10 rupees extra. This becomes 110. Due entry for redemption. Now, debenture holders account debited. Okay, to equity share capital if you are giving them shares. But if shares are issued at higher price, then to securities premium. Conversion into shares. Now, redemption of debentures. Purchase from open market. If you are redeeming the debentures and you are purchasing from open market, investment in own debentures account debited to bank. Investment in Own debentures account debited to bank. Purchase of own debentures. Purchase of own debentures. Okay, you purchase these debentures from the market and this is your own debenture. You purchase and hold them as investment, but you call them as investment in own debenture. Now, debentures account debited. Okay, debentures account debited. This is our own debenture when we are cancellation of debentures. Loss on cancellation debited. Okay, to investment in own debentures, investment gone and profit on cancellation. If purchased at more than face value, it is loss on cancellation. If purchased at less than face value, it is profit on cancellation. Okay. If any of this happens, it will be considered as profit or loss on cancellation. This or this, only one can be there. Both can't be there. Clear? Now, P&L account debited to loss on cancellation. If there is loss, transfer it to P&L. Excuse me. Profit on cancellation account debited to capital reserve. Both you have to understand. Now, purchase price of debentures from market. When you are purchasing debentures from market, the price will be quoted in two ways. One is called as ex-interest price, other one is called as cum-interest price. Ex-interest price means what? Price quoted is excluding interest. That means you have to pay the value for the debenture also and you have to pay the pending interest also. Cum-interest means what? Price quoted is including interest. The price quoted is including interest. Amount to be paid is cum-interest price. Okay, price quoted including interest. Amount to be paid is what? Cum-interest price. Okay, here amount to be paid is what? Ex-interest price you have to pay plus the pending interest also you have to pay. Imagine last time the company had paid interest 3 months back. Now if I am selling or purchasing the debenture, that pending interest also I have to give or I have to get. Now, price paid for debenture is equal to cum-interest price minus interest pending. Cum-interest price minus the pending interest, whatever is there, that is for cum-interest price. Because here if they tell 106, in 106, amount for investment is also there and amount of interest is also there. But ex-interest price when we are telling, this is it. Okay. You have to pay ex-interest price plus you have to pay the interest pending. Now understand this. If I tell ex-interest price 106, I have to pay 106 to purchase the debenture from open market plus I have to pay the pending interest. If I am telling 106 cum interest, in this only both are included. So calculate interest, transfer, record the entry for interest separately and differential amount is for the investment. Clear? Underwriting of securities. Underwriting of securities. Okay, meaning shares given by company to underwriter to get it subscribed by public. Shares given by company to underwriter to get it subscriber from public. This is basically when responsibility is given to an agent. Boss, you do all the work because if at all I don't get minimum subscription of 90%, then I'll be in trouble. So therefore, you get the subscription done. Agent. Okay, underwriter to be paid commission. That fellow is taking risks, he'll be given commission. Now there are some terminologies that you have to remember. Gross liability. Gross liability means what? Total responsibility taken by underwriter. 100 shares given to underwriter, that is gross liability. Net liability. Balance shares not taken by public. Out of 100 shares, 80 shares were taken by public. So that means 20 shares is a net liability for the underwriter. Marked application means what? In the application, underwriter seal is there or sign is there. That means it came from the underwriter. Applications with an identification mark of underwriter. Unmarked applications means what? Applications without any identification mark of an underwriter. Okay, came from public. We don't know whose work it was. Firm underwriting. Firm underwriting means what? Before going to giving to public or underwriter told these many shares I only want. Shares promised to be taken by underwriter before offering to public. Now underwriting commission. Underwriting commission, gross liability, what he had initially promised, that into the percentage. Now, percentage into number of shares taken as gross liability into issue price per share. Now, number of shares taken as gross liability into percentage, underwriting commission into issue price per share. Okay. So, basically on the total value, whatever is there, you apply the percentage. Computation of net liability. If it is a single underwriter, okay, gross liability minus shares taken by public, net liability. Only one underwriter is there. If multiple underwriters are there, create A and B, split the gross liability in whatever percentage, let's say 70-30, split it, put the marked applications, respective marked applications, you subtract, that time you will get one different balance. Unmarked application, whatever is there, distribute in this ratio only. This gross liability, what ratio is there? In that ratio only you distribute the unmarked applications, you will get the net liability. When you get the net liability, add the firm underwriting. Firm underwriting, what they had promised, no, add that. That time you will get the total liability. Now journal entry for taking the shares, underwriter's account debited. Okay, underwriter's account debited to equity share capital to securities premium account. Okay, this is basically this much money underwriter has to give us because we are giving him shares, the remaining shares. Commission we have to give him. So commission account debited to underwriter. We have to pay the commission. Next, if amount for the shares is greater than commission, amount what he has to give us is greater than the commission, then he has to give us money, bank account debited to underwriter. But if amount for the shares is less than the commission, that means we have to pay money, underwriter account debited to bank. With that, we are done with the discussion of chapter number 1. Clear? Now we have to go and see all the questions of chapter number 1. Okay. Now we'll see chapter number 1. Let's see question number 2. This is from December 2023. December 2023. Okay, onwards we will see all the previous year questions. 2. Yes, 2A. Now, past necessary journal entries with narration in the books of A Limited. Assume the rights issue was fully subscribed. Okay. A Limited has subscribed capital of 150 lakhs divided into 1,50,000 equity shares of 100 each fully called up. Okay. Company has taken the following decisions. 3,000 equity shares on which rupees 50 per share have been received are to be forfeited for non-payment of 30 on first call and 20 on final call. Okay, so 50 is to be on which 50 is received, 50 is not received. So now what will you do? Equity share capital account debited. See, equity share capital debited 3,000 into 100. What you have received should go to share forfeiture. So 3,000 into 50. What you did not receive, 3,000 into 30 plus 20, 50. Clear? This will be cancelled. Next. So second one we'll have a look at. 6,000 equity shares of 80 per share paid up are to be forfeited for non-payment of final call. That means 80 is paid up. Okay. 80 is the paid up value. 100 is not the paid up value. 80 is the paid up value. Out of 80, 60 is paid, 20 is not paid. Okay, 6,000 shares. Again, equity share capital debited 6,000 into 80. Okay, 80 is 80 is paid up. So 6,000 into 100. Okay, and this will be call scenario 6,000 into 20. And now 6,000 into 80. 80 is received. That is forfeited shares. It will go to share forfeiture account. Here, this is 100, this is 80, and this is 20. Clear? Yes. All the 9,000 shares were reissued at 90 per share. 3,000 plus 6,000, everything is reissued at 90 per share. Now, when it is reissued at 90 per share, no, 10 rupees per share is loss. So, what will you do? Bank account debited 9,000 shares into 90. 8 lakh 10. Then share forfeiture or forfeited shares 9,000 into 10. That will be forfeited. Then equity share capital face value. Now what you have to understand is, see over here, 6,000 shares. Okay, 6,000 shares. How much was the profit when we cancelled? The profit was 50. So 50 minus 10, okay, is the net profit. 3,000, sorry, that was not 6,000, that was 3,000 shares. 6,000 shares, okay, how much was the profit here? Share forfeiture 80. 80 minus 10. So this whatever is there, no, this has to go to capital reserve. So 3,000 into 40 and 6,000 into 70. So total amount that you're getting here is 5,40,000. Can you see share forfeiture to capital reserve 5,40,000 here? Yes, give me a hell yes, yes. Let's continue. Next, a right issue is to be made in the ratio of 2 shares for every 5 shares held at a premium of 30 per share. At a premium of 30 per share. Yes, right issue is to be made in the ratio of 2 shares for every 5 shares held at a premium of 30 per share. Okay. Now 150,000 shares are there. Okay, 150,000 shares. So 150,000 shares, right, shares in a ratio of 2 for every 5. 2 divided by 5. So 1,50,000 into 2 by 5, that gives us 60,000 shares. It is issued at a okay, held at a premium of 30 per share. So now look at this, bank account debited, okay, 60,000 shares. 60,000 shares. Okay, 60,000 shares. Right shares. Now, the right issues to be made in the ratio of 2 is to take. Okay, now here if you see 60,000 into 40, it should have been to equity share capital 60,000 into 10. That makes it 100, sorry, it should be 100. That makes it 60 lakhs. And here it is 60,000 into 30 rupees premium, 18 lakhs. So that's how it became 60,000 in 140. Sorry, not 140, 130, 78 lakhs. 60,000 into 130, 78 lakhs. That should be the situation. So 7 marks, they are asking this question in the exam. Easy 7 marks, cakewalk. Put it in the pocket, go. Next. After that, see, second one. Question number 2. Company is planning to raise funds by making right issue of equity shares to finance its expansion. The existing equity share capital of the company is 50 lakhs. The market value of its shares is 42. Company offers to its shareholders right to buy 2 shares for 11 for every 5 shares held. You are required to calculate theoretical market price after right issue. Theoretical market price after right issue. Now, they have not shown the calculation. Let me show the calculation here. How many shares do we have? Share capital is 50 lakhs. Share capital is 50 lakhs. Okay. So that means 5 lakh shares. So 5 lakh shares into, before right, what was the value? 42 into 42 plus, okay, how many shares for how many shares? They're offering right to buy 2 shares for every 5 shares held. 5 lakh into 2 by 5, 2 lakhs. So 2 lakh shares into, right issue price was what? 11 into 11. The whole thing divided by, right now, how many shares you have? 7 lakh shares. So 5 lakh into 42 and 2 lakh into 11. Now this whole thing divided by 7 lakh shares, you're getting 33.14. This is how you got 33.14. Theoretical ex-right market value per share. Now, value of right. Value of right, 42 was the price, correct? 42 minus 33.14. 42 minus 33.14. 8.86 is the value of right. Increase in the share capital. Array, 5 lakh shares we had. Now extra how much we are going to get? It's going to become 7 lakhs. So now extra 2 lakh shares. Obviously it is 40% increase. That's it. Done with that particular question. Okay, 2A and 2B both were from chapter number 1. This was your, what do you say, first chapter of December 2023. Now we'll go into June 2024 and see what were the questions that were asked in June 2024. Again, 2A, 2B, both from first chapter. 2A, 2B. Now, 2A, Jumbo Limited is planning to raise funds by making right issue of equity shares to part finance its expansion. Now, the existing equity share capital of the company is 40 lakhs. The market value of the share is 45. The company offers to its shareholders the right to buy 2 shares at 12 for every 5 shares. You are required to calculate theoretical market price per share. Just now what we did again. Okay, so how many shares are there? 40 lakh means divided by 10, it's going to be 4 lakh shares. So if it is 4 lakh shares, what we are going to do? 4 lakh shares into, what was the price before? Price before was 45. 4 lakh shares into 45 plus, now what's going to happen? 2 shares for every 5 shares held. So 4 lakh into 2 by 5, that's going to be 1,60,000 shares. 1,60,000 shares into, what is the price at which they are going to give this? At 12. So into 12, the whole thing divided by, we have right now 5,60,000 shares. So 4 lakh into 45 and 1,60,000 into 12. So this total divided by 5,60,000 shares, 35.57. Can you see 35.57 here? Yes, 35.57. Value of right. Share price was 40. Sorry, not 40, 45. 45 minus 35.57. 45 minus 35.57 gives you 9.43 value of right. How much it has increased? Okay, 2 by 5. 1,60,000 shares extra we have issued, divided by how many shares were there? 4 lakh shares. Obviously, it is 40%. 40% increase in the shares. This was your question for 7 marks. Okay, in June 2024. Value of right, percentage increase. B. Calculate the liability of each of the underwriters. Now, underwriter question they have asked. Let's get ready. This is also like a cakewalk question only. Now, see over here. T Limited invited applications from public for 2 lakh shares of 100 each at a premium of 20 per share. Now, the entire issue was underwritten by the underwriters A, B, C, D in the ratio of 30, 30, 20 and 20. Okay, 2 lakh shares in the ratio of 30, 30, 20, 20. If you do 30, 30, 20, 20. Okay, 60,000, 60,000, 40,000, 40,000. Gross liability. Okay, this is the gross liability. Okay, now, respectively with the provisions of firm underwriting. There was a firm underwriting. Okay, let's keep that in mind. Now, what we are going to do? Company received applications for 1,40,000 shares from the public, out of which applications of this was marked applications. Okay, all this was marked applications. So now they have directly gone to net liability only. So now if I do the calculation somewhere over here, 60,000 A, B, C and D. Okay, 60,000, 60,000, 40,000, 40,000. 60,000, 60,000, 40,000 and 40,000. Okay, now see this company listed applications of 1,40,000 shares from public. Out of this was marked 38, 20, 42, 16. 38,000, 20,000, 42,000 and 16,000. Okay, so now you have to see what's happening. 48, 58, 22,000 here and 40,000 here and 2,000 negative over here and 24,000 over here. Okay, the ratio was 30, 30, 20, 20. 30, 30, 20, 20. So now what will happen? This negative, whenever you get negative in underwriter's calculation, what you will do? You will just distribute it to the others. So now 3:3:2. So what will you do is 2,000 negative in the ratio of 3:3:2. 2,000 into 3 by 8. 750. Here also 750. That means here 2,000 positive. This will become 500. So this will become 21,250, 39,250. This becomes 0 and this becomes 23,500. This is the situation. Then what we have? Unmarked applications. Now see here, 140, out of 140 all this is marked. So 140 minus 38,000 minus 20,000 minus 42,000 minus 16,000. So 24,000 unmarked applications are there. 24,000 unmarked applications. Again, it will be distributed in the ratio. So 24,000 into 30%. So 7,200, 7,200 and 24,000 into 20%, that is 4,800 and 4,800. This will create a problem again, that is 21,250 minus 7,200, 14,050, and here 39,250 minus 7,200, 32,050, here 4,800 negative, and here 23,500, 4,800, 18,700 negative. 18,700 negative. So now what will you do? This 4,800 negative also distribute in the ratio of 3:3:2. So 4,800 into 3 by 8. This becomes 1,800, 1,800, 4,800, and this 1,200 positive. So now 14,050 minus 1,800, 12,250. 32,050 minus 1,800, 30,250. And here this is 0, and here 18,700 minus 1,200, 17,500. Clear? This is the situation that we have reached. Oh students, there was firm underwriting, no, in this. Firm underwriting 6422. 6,000, 4,000, 2,000, 2,000. Okay, firm underwriting. If I remove 6,000, 4,000, 2,000, 2,000. Okay. Then marked applications. Marked applications, if I remove marked applications, 38,000, 20,000, 42,000, 20,000, 42,000, and last it is 16,000. Okay, unmarked applications 24,000 into 30. Unmarked application, all I'm doing at once: 7,200, 7,200, 4,800, and 4,800. When you do this, you will reach 60,000 minus 6,000 minus 38,000 minus 7,200. 8,800, and here 60,000 minus 4,000 minus 20,000 minus 7,200. 28,800, and 40,000 minus 2,000 minus 42,000 minus 4,800, 8,800 negative, and here 40,000 minus 2,000 minus 16,000 minus 4,800, 17,200 positive. So this 8,800 will be distributed in the ratio of 3:3:2. 8,800 into 3 by 8. So 3,300. 3,300, 8,800, 8,800 into 2 by 8, 2,200. When you do this, I think now you will get the net liability. This is easy. 5,500, 25,500, 0, and this becomes 15,000. Still, it's not matching with the ICA, your institute's answer. Okay, but this is how it should be done. Add the firm underwriting now. Firm underwriting is actually 6,000. So this becomes 11,500 of total liability, and this is 4,000. So this becomes 29,500 of total liability, and this is 2,000. So add 2,000 total liability, and here also 2,000. So this becomes 17,000. So 11,500 plus 29,500 plus 2,000 plus 17,000. 60,000 is the total. If you see 2 lakh shares, 1,40,000 public. That means 60,000 has to be taken by underwriter only. This is the way to do it, guys. Okay, do it in this way. Done. June done. Let's go into December 2024. December 2024 also you have second question from this particular chapter. 2A. Yes. Now they have asked prepare necessary journal entries in the books of journal and to record the forfeiture and reissue. Working should form part of your answer. Okay, very good. Now P Limited issued 6,000 equity shares of 10 each payable as 3 rupees per share on application, 5 per share including 2 rupees premium on allotment, and 4 per share on call. All the shares were subscribed. Money due on all shares were fully received except M holding 100 shares failed to pay the allotment and call money, and N holding 200 shares failed to pay the call money. Okay, first we'll take care of the forfeiture. Now, I think they have passed one entry, right? Okay, now we have to understand the two people here, M and N. Okay, M has how many shares? 100 shares. And N has how many shares? 200 shares. N has 200 shares. Okay, failed to pay the failed to pay call money. Now, M has not paid allotment money as well as call money. That means M has not paid the premium which is there over here. Premium not paid. But N, premium paid. N has paid the premium. So if premium is not paid, then we have to reverse the premium. If premium is paid, we have to ignore the premium. Okay, so now understand this. 300 shares. This fellow, it is going to be 100 plus 200, 300 shares into face value of 10. Okay, 3000. Can you see 3000 here? Now only one person has not paid the premium, so his premium will be reversed. So 100 into, I think premium is what? 2 rupees per share. So 2 securities premium reversed. Now to equity share allotment account. Equity share allotment, who has not paid the allotment money? Only this guy has not paid the allotment money, and allotment money is how much? 5 rupees. So 100 into 5 rupees. Okay, 500. Now both have not paid the call money. So 300 into, what was the call amount? 4 on call. 300 into 4, 1200. And what have they paid? M has paid application money. M has paid only application money because he has not paid allotment and call. So 100 into application money was how much? 3 per share on application into 3 plus, okay, and the other guy has paid application and allotment 200 into 3 plus 3. 200 into 3 plus 3. Premium we are not reversing, no. So 200 into 6 plus 100 into 3. 1500. That is your 4 feature entry. Alternatively, you can use calls and areas instead of using the allotment and call accounts. Next, all the 300 shares were forfeited. Okay, of the shares, 250 shares, including whole of M shares. So M shares fully reissued. So 100 reissued, and here only 150 reissued. So that's why 250 is the total number of shares that is reissued. So now what happens? 250 into, how much are we reissuing it at? At a paid up price of 8. 250 into 8, that makes it 2000. Okay, forfeited shares, 250 into 2, 2 rupees per share is loss. 500. To equity share capital, 250 into 10. Clear? Now forfeited shares, what we have to understand? Okay, how much is there over here? Now 100, profit was how much? This fellow, okay, he had paid how much? 3 rupees. 3 minus 2 loss, 1 rupee net profit. Okay, this fellow had paid 3 plus 3, 6. Ignore the premium. 6 minus 2 rupees, 4 rupees profit. So therefore, 100 shares into 100 rupees profit. And here only 150 is reissued. 150 into 4, 600 rupees profit. 600 plus 100, 700 rupees will be transferred to capital reserve. Can you see? This 600 and this 100, 700 rupees will be transferred to capital reserve. Done. Next, Akash Limited, okay, has issued 2012% convertible debentures of 100 each, redeemable after a period of 5 years. According to the terms and conditions of the issue, these debentures were redeemable at a premium of 5%. So we have to pay 105 on redemption. The debenture holders also had the option at the time of redemption to convert 20% of their holdings into equity shares of 10 each at a price of 20 per share and get the balance in cash. Debenture holders amounting to rupees 40,000 opted to get their debentures converted into equity shares as per the terms of issue. You are required to. They have the option to convert to how much? 20% of their holdings only. So 40,000 means, now see, number of debenture holders opting for conversion 40,000 divided, that means 400 debenture holders. Only 20% they can convert. So how many debentures we can convert into shares now? 80. 80 debentures we can convert. So 80 into 105. 80 into 105. That makes it 8,400. 8,400 we can convert. Okay, 8,400 divided by, we are issuing it at what price? 20, right? So divided by 20, 420 shares we can convert. We can issue on conversion. Calculate number of shares to be issued. Calculate cash to be paid for these people. Now, cash to be paid, simple. 80 shares converted, 320 shares not converted. 320 into 105, 33,600. Okay, now pass journal entry for conversion. Debentures, due entry, you have to pass first. Due entry, debentures account debited. 80 into, sorry, not 80, 400 into 100, 40,000. 400 into 5 is the premium, 2,000. Two debenture holders, full 42,000. Now, debenture holders account debited. 2, equity share capital. How many shares we are issuing? We are going to issue 420 shares. So, 420 shares into 10 rupees will go to share capital. 420 rupees, 20 shares into 10 rupees will go to securities premium. And 420. So, next 320 into 105, which we already calculated, 33,600 we have to pay. Okay, narrations obviously we have to pass. We already know that. This is your December 2024 paper. Done. Now we go into June 2025, the most recent one. First question. They asked buyback. Pass necessary journal entries for buyback. Very good. Next. Okay. Alpha Limited has paid up equity share capital of 20 lakh in 2 lakh shares of 10 each. It resolved to buy back 50,000 equity shares of 15 each. For this purpose, for the purpose of buyback, what they are doing? They issue 20,000 12% preference shares of 10 each at par, payable along with application. Payable along with application. Now, the company has to its credit 2,50,000 in securities premium and 10 lakh in general reserve. The company utilized the general reserve. Now, first what we will do, we are issuing preference shares. So, we are going to issue how many preference shares? 20,000 preference shares at par. So, bank account debited to preference share application, 20,000 into 10, 2 lakhs. Then, preference share application to preference share capital. Sorted till here. Preference shares are issued. Now, how many shares are bought back? 50,000 shares are bought back at 15 rupees per share. Remove the equity share capital. This is 50,000 into 10 equity share capital debited. Now, extra 5 rupees you are paying. So, 50,000 into 5. Directly, they have debited securities premium. You could have done premium on buyback debited. Then you could have transferred it to securities premium. But no problem. To equity shareholders account. Then equity shareholders account debited to bank. This is the due entry. And this is the payment entry. Equity shareholders account debited to bank. Now, what is happening? How much equity share capital is gone? Face value of equity share capital gone is 5 lakhs. Face value of preference shares which came is 2 lakhs. 5 minus 2, 3 lakh is transferred to capital redemption reserve. 5 minus 2, 3 lakh is transferred to capital redemption reserve. Whenever preference shares are redeemed or equity shares are bought back, you should always create CRR. How will you create CRR now? Just remember something. Okay, equity shares are bought back. Equity shares bought back, face value minus preference shares issued, face value. CRR creation, difference. Preference shares are redeemed. Preference shares redeemed, face value minus equity shares issued, face value, difference, CR. Done. Now 2B. Let's go into 2B, guys. Okay. Now let's go into the next one. The following balances appeared in the books of B Limited as on 31st March 2024. 9% debentures. Debenture redemption fund. Debenture redemption fund investment. Okay, now you can see they have asked to prepare ledgers. Debenture redemption fund is DRR, by balance brought down. Debenture redemption fund is investment is an asset. So 2 balance brought down. 2 things sorted over there. Now after that, let's see what they have asked. Annual contribution to debenture redemption fund was 2,10,000. 2,10,000 every year we transfer. So by P&L, say 2,10,000 transfer. Then company sold its investment for 21 lakhs and redeemed the debentures on 31st of March 2025. That's it. If there was 15 lakhs, so full year we will get 9% interest. So 1,35,000. That interest also gets added to the fund itself. 1,35,000. So much money we had in the fund. Okay. Plus we transferred again 2,10,000 to the fund. Now what is going to happen? Okay, now debenture redemption, debentures, see, it is sold for 21 lakhs. When we sold for 21 lakhs, we got 6 lakhs profit again. That 6 lakhs is also again transferred to the fund itself. So right now in the fund, we have 15 lakhs plus 1,35,000 interest, plus we have 2,10,000 annual transfer from profits, plus 6 lakhs profit on sale of investment. 24,45,000 we have. Okay, all this, whatever is there, transfer to general reserve. Debentures are redeemed, right? Transfer to general reserve. That's it. That's as simple as that. If it is asked in the exam. Now see, 6,000, 6 lakhs the profit. Done, finished. They've asked you to prepare ledgers. Next, we go into model test papers. We start with December 2023 set 1. December 2023 set 1, I'm starting with. Yes, let's go into the model test papers for chapter number 1. We'll go into model test papers. Okay, first, this is basically December 2023 set 1. Okay, B Limited was formed with an authorized capital of 2 lakhs. Now go into the next. See, they are asked as journal entries only. Authorized capital of 2 lakhs of 10 each on 1st October 2021. 1 lakh shares were issued as fully paid up to the vendor and 80,000 shares were offered for public. 1 lakh shares were paid to vendor. Okay, so the entry for that will be sundry assets account debited to vendor. First you purchase the assets, then vendor account debited to equity share capital. Clear? Simple. Then 80,000 shares were offered for public, 2.5 per share payable on application, 2.5 on allotment and 2.5 on first call due on 1st December and 2.5 on final call due on 1st March. On the shares subscribed by the public, there had been paid 30th September the following. On 60,000 shares, the full amount called. On 18,000 shares, 7.5 per share, and 500 shares, 5 per share, and 1,500 shares, 2.5 per share. On 30th September 2022, the directors forfeited the shares on which less than 7.5 has been paid up. Okay. So what has happened over here is, on the shares that we have offered to public rate had been paid on 30th September 2022 following amounts. 30th September 2022, okay, if you notice, 1st December, okay, this is 2021, whatever they are talking about. Next year they are telling. Next year, 30th September 2022, this is the situation. Full final call has been made. Everything is done. Now, first, equity share capital to, bank account debited to equity share application and allotment. So, how many shares we have? 80,000 shares into 2.5 and 2.5. So, into 5. Okay, into 5. See, 80,000 into 5 should be 4 lakhs. Next entry, they have made it 4 lakhs. So, this is a error from the institute. So, this should be 4 lakhs, 4 lakhs. Okay, next, October 1st. Everybody paid. See, everybody has paid. Okay, actually, they have merged, like they have done in some stupid order. First, they have done 80,000 into 2.5 just application, but they have written allotment also. Only application, this is 2 lakhs. Okay, then equity share application and allotment 80,000 into 5. Okay, they have transferred to share capital. Now, see what happens over here. Out of 80,000, somebody has not paid application money. Can you see 1,500 shares, only 2.5 they have paid. They have not paid the allotment money. 1,500, only 2.5. So remove that 1,500. Okay. So 80,000 into minus 1,500. You get only 78,500 shares into 2.5. Into 2.5. 196,250. Okay. Because they didn't pay the application money. Now when we go into remaining, everyone has paid till 5 per share. No, can you see on 500 shares only 5 per share, but only 1,500 shares they have paid 2,500 per share. 1,500 shares, what happened? They have paid 2,500 per share. So now what is going to happen is bank account debited to equity share application and allotment account done. Now we'll make the call. When we are making the call, 80,000 into 2.5. 2.5 is the first call. Now, bank account debited. You don't have to write like this first call arrears and all. Just write calls in arrears. I don't know why they are doing that. Now, see, 500 shares, he has paid only 5 per share. That means this 500 and this 1,500, they have not paid the first call. So, now what happens? This will be 80,000 minus 2,000 shares into 5 rupees. Sorry, into 2.5 rupees. So, 80,000 minus 2.5 into 5. 80,000 minus 2,000 shares into 2.5, 1,95,000, and the 2,000 shares into 2.5, 5,000 is calls and arrears to equity share first call. Then equity share when we go to second call. Okay, second call again, it is 2.5 only. So 80,000 into 2.5, we make the call. Okay, then when we receive the money, again, who has not paid? This person has not paid from application. This person has not paid. This person has not paid allotment. This person has not paid first call. This person has not paid final call. So basically 18,000 plus 500 plus 1,500, total 20,000 shares we have not received the final call amount. So final call when we are going, see, this is going to be 60,000 shares into 2.5. So 60,000 into 2.5 will give you 1,50,000, and 20,000 shares into 2.5. That gives us 50,000. To equity share second call 2 lakhs. Clear? This is how it's going to work. Now after that, when we go further, see, on 30th September, the directors forfeited the shares on which less than 7.5 has been paid. So all this less than 7.5, less than 7.5 has been paid. On that, they are going to forfeit. So when they are forfeiting that, understand this, 20,000 shares we have. Oh, sorry. So they are going to forfeit. Yeah. So all the shares are not going to be forfeited, guys. So less than 7.5. This person has paid 7.5. No, so there is no problem. Only these two shares they are going to forfeit. So now here what happened? 2,000 shares. 2,000 shares into 10. That is 20,000. Gone. Okay. 2 calls in arrears. Now this split is not required. This split is not required. Okay. Either you put together calls in arrears or you do equity share application and allotment. Okay. So here what happens? One person, the 500 rupees, 500 shares, they have paid us 2.5. Okay. Plus 1,500 shares, they have paid us 5 rupees. So 1,500 into 5 plus 500 into 2.5, totally. Yeah, see over here. Where am I getting the information from? Over here. Oh, sorry. 1,500 shares, they have paid 2.5. My bad. 1,500 shares, they have paid 2.5, and 500 shares, they have paid 5. So 1,500 into 2.5 and 500 into 5. So 6,250 we have received. That means 1,500 we have not received 7.5. So 1,500 into 7.5, 11,250. Okay, plus 500 we have not received 5. So 500 into 5, 2,500. So 11,250 plus 2,500. Total 13,750. This total. Don't split it and write one only. Either calls in areas or you write equity share application allotment. Then what they are doing? They are reissuing that shares. Okay, the shares are reissued. Calls in areas on 18,000 shares were collected on 31st together with necessary interest. The forfeited shares were reissued on the same day at 8 per share. Okay, now forfeited shares are 2,000. So now what is happening over here? Here I'm going to this entry, 2,000 shares into 8. They got 16,000. But 2,000 shares into 2 is the loss. That is 4,000. Then 2,000 shares into 10. That is the face value, 20,000. Clear? Now forfeited shares. Okay, 2,000. How much was the share forfeited here? 6,250 minus loss 4,000. One second, guys. Okay. 6,250 minus loss 4,000. 2,250 gets transferred to calls in arrears. Now here we have to understand. Okay. See over here. We are receiving the money. How much money are we receiving? We are receiving money on what dates here? On 30th September 2022, they have received 18,000 shares were collected on 31st October 2022. When was the final call supposed to be made? 1st March. It was due on 1st March. So March, April, May, June, July, August, September, October. 8 months delay. 8 months delay. So what's going to happen now is 18,000 shares. We got the final call amount 2.5. So 18,000 into 2.5 is 45,000. Okay. Plus they're getting the interest also. That is basically 45,000 into, yeah. So So on 45,000, what happens here? See, on this 45,000, whatever interest is there, no, that has been calculated. Interest on calls and arrears. Okay, and 2 calls and arrears 45,000. So totally 46,500. Yeah, that is it. And then that is transferred to P&L. That is transferred to P&L. So that should be it with this particular question, guys. It's a little tricky question. Just be careful with the dates. Okay. Next, we go into the next part. Ratan and Co issued 10,000 shares of 100 each at a premium of 20 per share. The entire issue was underwritten as follows. Okay, so A 5,000 shares, B 3,000 and C 2,000 shares. Okay, so we start with gross liability always 5,000, 3,000 and 2,000. Okay, minus unmarked applications. Now, what is the unmarked application? See over here. Compute the liability of each underwriter and compute how much commission will be assuming it is maximum allowed by law. Now, the following is marked applications, blah, 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 blah. Okay, now, see over here. Shares applied were 9,000 shares. Here we have how much? 2,500 shares. Sorry, here we have how much? 2,000 shares. Firm underwriting is 2,000 shares. Okay, minus unmarked applications 2,500 shares. Now, if you see over here, 9,000 shares were applied for, 3,500 marked, 3,500 plus 1,400 plus 1,600. So this is totaling up to 6,500 shares. That means out of 9,000, 6,500 is marked. That means 7,500, 8,500, 2,500 is unmarked. That is distributed in the ratio 5:3:2 because the ratio is 5:3:2. That time you get the balance. Then marked applications are directly subtracted. Okay, then you'll get the balance. Now there is deficit. Deficit obviously will be transferred. You know what to do in the ratio of 5:3. Net liability you got. Now add the firm underwriting. You'll get their total liability. This is their total liability. This shouldn't be a problem. Now commission calculation maximum permitted by law. They said law is permitting 5% commission. So what will you do? Total 5,000 into 120 into 5. Okay, why 120? Because we have to take the issue price. It is issued at a premium. Okay, so this person 5,000 shares into 120 into 5. Okay, 5 divided by 100 they have done. Directly they could have taken 5%. This is the amount. These are the commissions. This also shouldn't be a problem. Okay, for us. Next, let's go into the next one. Now, December 2023. Okay, let's check December 2023. Shares and debentures. Okay, now yes, so XYZ Limited has the following structure as on 31st March 2022. Clear? Now, say equity share capital, you have general reserve, securities premium, P&L, export reserve. This is the statutory reserve. Ignore, leave it out of the door. Okay, and then there is loan funds. The shareholders have, on recommendation of the board of directors, approved by special resolution at their meeting on 10th April, a proposal to buyback. Proposal, only proposal. That means their option is given. Okay, maximum permissible equity shares considering huge cash surplus. The market price was hovering in the range of 25, and in order to induce the shareholders, that means tempt the shareholders to give the shares, they are offering their shares at 20% above. That means 25 plus 20% when you add, it becomes directly 30 rupees per share. 30 rupees they are planning to give. Examine the maximum number of shares that can be bought back by the company and record the journal entries for the same. Okay, assuming buyback is completed within 3 months. If borrowed funds were 1,200 and 1,500, two other options also they have given. So because you see that debt equity ratio test, it will test us, no, how much borrowed funds are there. Yes. So now first share outstanding test. Now see over here, share outstanding test. How many shares are there right now? All in crores only will take 300 divided by 10. That means 30 crores. 30 crores into 25%. Share outstanding test 25%. 7.5, 7.5, 7.5. Clear. Next we go into the next one. 300 plus general reserve plus securities premium plus P&L. I told you resource test you have to take all this. So 300 plus 270 plus 100 plus 50. So you have 720 into 25%. Into 25%. 180. Now this 180 is in rupees divided by 30. Divided by 30 you are getting what? 6 crore shares. So you can see the next one is 666. But debt equity ratio test is not like that. Now let's say see over here, debt equity ratio, situation 1, situation 2, situation 3. Minimum which has to be maintained is what? 2:1. So minimum that means half has to be maintained. So 400, 600 and 750 we got. Okay, now present equity. Present equity just now we saw it is 720, 720 and 720. Okay, now I'll tell you one easy methodology. They have done taking X and all that. Now 720 is there, right? Okay, 720 is there. 320 you have to keep. 320, 120 and 0. Here you have nothing to keep. So obviously buyback is not possible. Now, understand this, guys. This is a very important part. 800 minus 400. Sorry, 800 divided by 2 gives you 400. Minimum equity to be maintained. Now present equity 720. We have more. That means 320 can be utilized. Here we have more. That means 120 can be utilized. Here right now we are sitting at 720. We are already less than the minimum. So it's 0. We can't utilize anything. Now 320 divided by 30 rupees for buyback, 10 rupees, 30 rupees for buyback and 10 rupees CRR. Just take 320 in your calculator and divide by 40. Okay. Maximum number of shares that can be bought back. So 320 divided by 30. This is wrong, guys. It cannot be 10.67 because you have to need money for even CRR creation. This is wrong. It cannot be 10.67. It should be 40 here. 30 rupees for buyback, 10 rupees for CRR. So 320 divided by 40, 8 is the answer here. And here 120 divided by 40, 3 is the answer here. Here anyways 0. So 8, 3 and 0, transfer it. Okay, that time you will get anyways least is 6. Here it will be, see, when putting over here, they have put 3 only. They have put 10.68 here they have put 3. So just ensure divided by buyback price plus CRR. Okay, and then you have to pass journal entries. Situation 1 and 2. What is the entry? Equity share capital account debited to. Okay, full mess up of order. First entry should be this: equity share capital account debited to share buyback account. Share buyback account. Clear? Now here in this answer it is 180. Then the entry is this: share buyback account debited to bank. Okay, then you have to transfer the premium. How much is the premium? Oh, sorry, it is not 180. Equity share capital account debited. You pass this entry as the first entry. Equity share capital account debited. Okay, how many shares we are buying back? 6. So 6 into 10, 60. Premium on buyback debited 6 into 20, that is 120. 2. Equity share buyback account 180. Then you pass the entry. See now what they have done over here. Okay. Then what you will do, equity share buyback account debited 180 to bank. Now premium you need 120. Go and check how much is there in the securities premium. 100. Take securities premium 100, remaining you take from general reserve. See over here, securities premium 100, general reserve you take remaining 20. Okay, and that you transfer to premium on buyback. Then you have to create CRR. CRR is always created for the face value. Face value was 10. So 6 into 10, you're going to create CRR. Complete mess up of order. Don't follow this order. First due entry, then payment entry, then premium transfer entry, then CRR creation. Okay, that should be it with this particular question. We are done with December 2023 first question. Then we have one more question here. Prepare debenture redemption fund account and debenture redemption fund investment account for 4 years. So on 1st April 2018, H Limited issued 442 10% debentures of 1000 each at a discount of 10%, redeemable at a premium of 5% after 4 years. It was decided to create a sinking fund for the purpose of accumulating sinking funds to redeem the debentures and to invest in some readily convertible securities yielding 10% interest per annum. Reference to the table shows that 1 rupee per annum at 10% compound interest amounts to 4.641 in 4 years. Investments are to be made in the bonds at 1000 each, available at par. On 31st March 2022, investments were realized for after 4 years. So let's start the question first. Debenture redemption fund account and the debenture redemption fund investment account. Now, first, what they are going to do, okay, have a look at this. See, face value of the debentures was 4,42,000. Okay. Again, we have to pay premium payable on redemption. On redemption, they have agreed for a premium. So you add the premium. So this is the total amount that is payable. Okay. Annuity cost, they have already given the annuity cost. When you divide that, 4.641, when you divide that, you'll get 1 lakh per amount has to be charged. Now, calculation of the amount of investment and interest. See here, every year they have given opening balance. It's like a repayment schedule. What we used to do, no, in other accounting standards and all, repayment schedule. like in lease when we did. Okay, opening balance, interest, okay, and what we are investing, investment, what it becomes, and this is the closing balance. Okay, it's a simple calculation, so you can just have a look at that. Okay, regularly they're asking sinking fund. Okay, just it's a methodical method. Just keep on putting the amount, you'll get the answers. So next we'll go into June 2024. There are no twists and turns in sinking fund, guys, so you can just do it on your own. Okay, but do not skip it because regularly they're asking question on sinking fund. Exam they haven't asked. I think one attempt they asked, but that is only for 1 year. They asked 4 years and all, they did not ask. Now, next, prepare journal entries for the following. PK Limited forfeited 10,000 equity shares of 10 each for non-payment of first call of 2 and final call of 3. These shares were reissued at a discount of 3.5 per share. Okay, 10,000 shares. Now, see over here, 10,000 into 10 equity share capital. Now, calls in arrears. What have they not paid? They have not paid 2 and 3. So, 10,000 into 5. What did they pay then? 10,000 into 5. What they did not pay is also 5. What they paid also is 5. Exact half the amount they have paid. These shares were reissued at a discount of 3.5. That means they have reissued at 6.5. Bank account debited 10,000 into 6.5. Okay, but 10 rupee share when it is issued at 6.5, there is a 3.5 loss. So 10,000 into 3.5. Okay, then everything face value goes to share capital. Now 5 rupees profit, 3.5 rupees loss. That means 1.5 rupees is the net profit. Okay, what we have, forfeited shares to capital reserve, 10,000 into 1.5. 10,000 into 1.5. Clear? This is the first journal entry that they have asked. Next, we'll go to the next one. KP Limited forfeited 20,000 equity shares of 15 each, including 5 per share as premium for non-payment of final call of 3 per share. Out of these, 10,000 shares were reissued at a discount. Non-payment of final call of 3 per share. That means the premium is already received. So ignore the premium. 20,000 into 20,000 shares into 10 equity share capital debited. What have you received then? Non-payment of 3. Premium you ignore. Premium you ignore. That means 7 you have received. So 7 rupees you have received. So 20,000 into 7 will go to forfeited shares. And 20,000 into 3 calls in arrears because we have not received that. Then these shares are reissued. Okay, it is reissued at a discount of 4. That means it's reissued at 6 rupees per share. So 20,000 into, one second, they have not reissued everything. Oh, of this only 10,000 shares are reissued, sorry. So 10,000 shares into 6 rupees, 60,000, and here 10,000 shares into 4 rupees. That is a loss. We'll take from share forfeiture. Everything goes to share capital. Now profit was how much? 7 rupees was collected. Okay, 4 rupees is lost, 3 rupees is the net situation. So 10,000 into 3 will get transferred to capital reserve. Clear, guys? Yes. Third one, KP Limited forfeited 15,000 shares of 15 each, including 5 per share as premium for non-payment of allotment money. Okay, non-payment of allotment money of rupees 8, including premium and the first and final call of 5 rupees. Out of this, 10,000 shares were issued at 14. Now, here premium amount is not received. So premium also has to be reversed. If you see now, 8 rupees, 5 rupees is premium. So now if you see, first and final call is 5 rupees. So if I take application, allotment, first and final call is 5 rupees. And here it is 8 rupees. So 3 plus 5 rupees it is. So this application amount is 2 rupees. So total amount is how much? 10 rupees. 10 plus 5. Total amount is 10 plus 5. So now if you see this situation, what will happen is allotment money is not received. Till here, everything is fine. Okay, till here everything is fine. Basically only application money you have received. So now premium is not received. Premium has to be reversed. So how many shares? 15,000 shares. So now equity share capital debited 15,000 shares into 10. Then securities premium not received. So we have to reverse the securities premium. 15,000 into 5 is the securities premium. 2. Calls in arrears. What did we not receive? Calls in arrears. Calls in arrears 8 plus 5, 13 rupees we have not received. 8 plus 5, 13 rupees we have not received. So this becomes 15,000 into 13. 15,000 into 13, you get 1,95,000, and forfeited shares 15,000 into 2, 30,000. 15,000 into 2, 30,000. Clear? Next, you are going to reissue how many shares in this? We are going to reissue only 10,000. Sorry, we are going to reissue how many? Yeah, 10,000 shares at 14 rupees per share. Now, if you see 10,000 into 14, bank account debited because we received that amount. Transfer the face value to equity share capital, transfer extra amount 4 rupees to securities premium. Now, how much share forfeiture? How much we had forfeited shares here? 2 rupees, and we did not issue at a loss. So, no loss here. Entire amount will be transferred to capital reserve. Entire 2 rupees will be transferred to capital reserve. Is it clear? Yeah, that should be it with that particular question, 2A. So next we go into 2B. 2B, again required to pass journal entries. Now see over here, balance sheet of Pixel Limited is given. On 1st January, the fixed assets costing 40 lakhs were sold for 32 lakhs. It was decided that on 1st February, the company issued sufficient number of equity shares, sufficient at par, so as to finance the redemption at 20% premium. The redeemable preference shares are there, no, that they want to redeem it. And to leaving a balance of 10 lakhs in the reserve. 10 lakh they have to keep. All the payments were made except to a holder of 10,000 shares who could not be traced. The company also made a bonus issue to the existing in the ratio 1:10. That is equity shares we are giving bonus. Now see, requirement of fund for redemption. How much money we require? Now see, preference shares are 1 lakh. Okay, 100 they have given. 100 lakhs, sorry. 1 lakh preference shares, 100 lakhs. Calls in arrears is already there. Can you see calls in arrears? What are we not giving? Calls in arrears on 20,000 shares is 4. So if something is, calls in arrears, you can't redeem those. Do you remember only fully paid up shares can be redeemed? So 20,000 shares into 100 rupees. 20,000 into 100 gives us 20 lakhs. That cannot be redeemed. So only balance 80 we are going to redeem. When we are going to redeem, it's going to be redeemable at a 20% premium. So at the premium, you need 96 right now. Requirement is how much? 96 you require. Okay, so for 96 when you have to require, okay, when you require 96, understand this. They said that you can utilize how much premium they said? They can, you're leaving 10 lakh in general reserve. Out of this, we can utilize only 20. This can be utilized full and this can be utilized full. Now see over here, premium is how much? 20. Sorry, 16. So out of 16, 15 securities premium is utilized. Okay, then P&L we can utilize 1. P&L we can utilize 1 and remaining is used for face value. Face value means what? To create CRR. Okay, general reserve 20, full, if not full, 10 we kept aside. So when we do all that, we are getting balance fund requirement is 60. So 60 has to be fresh issue. You have no other option. Because if you don't create, if you cannot create CRR, the only other option is issue shares. When you issue shares, that time share capital increases. So that gets compensated for each other. So you have to get 60 lakhs from here, and equity shares are going to be issued at what value? They did not tell anything. Sufficient number of equity shares at par, they said. So now actual, if you see 60 lakhs, we have to issue new shares. New issue will be 60 lakhs. Now what happens? 60 lakhs is the new issue. 60 plus, we have how much now? 100. So 160. Okay, 60 plus 100, 160 bonus shares are going to be issued. But see, they have done like this. Existing equity shareholders issue to existing equity shareholders. That means natural assumption they have taken that for the current new issue of equity shares, we are not giving. Okay, then only for these people we are going to issue. That means 10 will be the bonus issue. 10 will be the bonus issue. Okay, see over here. CRR to bonus to shareholders to equity share capital. And here what's going to happen? We are going to sell the asset first, incurring a loss of 8. Then bank account debited to equity share capital 60. Okay, redeemable preference shares, premium on redemption to redemption of preference shareholders. Okay, 96. Then general reserve and P&L we are taking and we are creating CRR. Okay, we can create only that much. We are creating CRR, securities premium we are using, and P&L we are using to remove that premium on redemption. Okay, finally the payment entry. It's in a shuffled order by the institute. Don't follow that. You can use the normal order itself. We'll go to the next one, guys. December 2024. Okay, set 1. Okay. Jackass Limited issued 1 lakh equity shares. Application 1, allotment 2, first call 3, and final call 4. All money payable on application, allotment, and calls have been received with the following exception. Beam, who holds 1000 shares, has not paid the money due on allotment, and Ram, who holds 500 shares, has not paid the money due on first call and first and final call. Okay. Sam, who holds 300 shares, has not paid the due on first final call. The shares of Beam, Ram, and Sam were therefore forfeited. These shares were subsequently reissued for a cash of at a discount at a 5%. 5% discount means they would have issued at 9.5. Past journal entries recording the above transactions and receipt of application money till reissue. Okay. Application everybody paid 1 lakh shares into 1 rupee. See. Bank account debited to equity share application 1 lakh into 1. Equity share application account debited to equity share capital. They have merged allotment with this. 1 lakh into 2 is the allotment amount. So 2. Okay. Bank account debited to share allotment. Everybody has not paid allotment. Who has not paid allotment now? Ram has not paid the money due on first call and final call. Sam, who has 300 shares, has not paid the final call. But here Beam has not paid the money due on allotment and calls. So Beam has how many shares? 1000 shares. So that means out of 1 lakh, 99,000 shares only we got the money. 99,000 into 2, 1,98,000. Clear? Now we make final call. When you make we make first call. When we make the first call, we call money from everybody. So 1 lakh into, what is the first call amount? First call amount was 3. Okay, into 3 lakhs. Now 1 lakh minus Sam has not paid. Sorry, who is that person, guys? Rama. Sorry, Beam. Beam has not paid. Who has not paid allotment obviously has not paid first call also. And there is now one more person called Ram has not paid the due on first and final call. So 98,500 only into 3 rupees. 98,500 into 3 rupees, you get 2,95,500. Then what happens? Second and final call, we are going to make the call again 1 lakh into 4 rupees. So 4 lakh rupees we are going to ask. Now who is not going to pay? Sam is also not going to pay. Sam 300 shares is not going to pay. Final call also. So now this becomes 1 lakh minus first Beam, then Sam 500, then this person. First Beam, Ram and Sam, sorry. Okay, so 1000 plus 500 plus 300. That's 1 lakh into 4 rupees. Into 4 rupees, you'll get 3,92,800. This is the situation. Then what we are going to do? We are going to forfeit everybody's shares. Everybody's shares are forfeited. Now if you see, 1,800 shares we have into share capital of 10. Okay. Equity share capital debited. Now you have to be a little careful. Share forfeited. Okay. Share forfeited. The first person has paid only 1 rupee per share. The second person has paid 1 plus 2 per share. The third person has paid 1 plus 2 plus 3 per share. This is the amount that we have received. Now, share allotment, what we didn't receive only from the first person, 1000 into 2. Then share first call we did not receive from first and second person, 1500 into 3. Then the share final call we didn't receive from first, second and third person, 1800 into 4. Is it clear? Okay, this should be the situation. Then we are going to reissue everything. I told you that time only 5% discount means 9.5. So bank account debited 1800 into 9.5. Share forfeiture 0.5 loss to equity share capital. Now here totally we made share forfeiture 4,300. Here 900 loss. So 3,400 will be transferred to capital reserve. 3,400 will be transferred to capital reserve. Clear? That should be it, guys. Next. XYZ Limited is issuing 20 lakh shares of 10 each to the public. N Limited has been appointed as the underwriter for 5% of the issue size. 5% of the issue size. Commission payable to the underwriter is 5% of issue price. Okay, calculate the amount of underwriting commission payable to N Limited if the shares are issued at par. How will your answer change if the shares are issued at 20% premium? 20 lakh shares we have. Okay, very good. Now see over here. 20 lakh shares into 5%. Only 5% we are giving to underwriter 1 lakh shares. 1 lakh shares into 10. That means 10 lakh is this gross liability. On gross liability, what we are going to do? 5%, 50,000 is this commission. In case it is issued at 20% premium, that means it's going to be 1 lakh shares into 12. Okay, that makes it 12 lakh. 12 lakh into 5%, that makes it 60,000 commission. Easy question. They've asked for 7 marks. Clear? Yes. Next, let's go into the next one, guys. Yeah. Second question again. Now, see this. On 1st May 2023, Superman Limited issued 5,000 equity shares of 100 each payable as follows. Application 20, allotment 30. Okay, first call 20, final call 30. Last date for payment they have given 31st July and 30th August. Applications were received on 15th May 2023 for 6,000 shares and allotment was made on 1st June. Applicants of 2,500 shares were allotted in full. Now this is a pro rata question. Pro rata question. Okay, and 3,000 shares were allotted 2,500 shares and applications for 500 shares were rejected. Balance amount due on allotment were received on 15th June. Now, let's first go and check if they have done any working to show you the situation here. 2,500 shares allotted 2,500. 3,000 shares allotted 2,500. 500 shares allotted nil. So application money received is 2,500 into 20, 50,000. 3,000 into 20, 60,000. 500 into 20, 10,000. This is going to be rejected anyways. Now here what we are going, application money required. We need 2,500 into 20, 50,000. Here what we are going to do, 2,500 into 20. We need 50,000 here also. But we got 60,000. So 10,000 is refundable. But here what we are doing, because we are going to give shares anyways. Now why to refund? Adjust this 10,000 with allotment. Okay. Adjust it with allotment. Now allotment money due 30 rupees per share. Okay. 2,500 into 30. This person also we gave 2,500 into 30. But out of that he has already paid 10,000 earlier. That is going to be adjusted. Only 65,000 will be received at allotment stage. This 10,000 whatever is there, that is fully going to be refunded. Now see over here. Okay. Equity share application account debited to equity share capital. I don't know why they are doing directly. Okay. Here, first of all, the bank entry should come first. Okay, it's a mess, no? They have missed the bank entry itself. See. Guys, you don't go in this. Where is the amount received? Amount is not received only. Oh, wait. Are they putting everything into cash book? Oh, you are required to prepare cash book and journal entries. Oh, such a mess. Okay, see over here. Now, cash book they have asked. So, entry is what? Bank account debited to equity share application. 6,000 shares into 20. 1,20,000. Clear? Now, application account debited. Application account debited. Okay, application debited. Now what they have done is 10,000 refund is there. No, that guy whom we are not issuing shares, that is 500 shares into 2. We are not giving any shares. So 10,000 refund straight away. See here. Equity share application to bank. Done. Now remaining, okay, equity share application debited 1,10,000. Out of 1,20,000, 10,000 refunded. 1,10,000. We are transferring to share capital 1 lakh and 10,000. Remember, we had seen that we are going to adjust it with allotment, that 10,000. Next, allotment due. Equity share allotment to equity share capital. Only for 5,000 shares anymore. 5,000 into 30. Clear? 1,50,000. Now we are going to receive money. When you are going to receive money, understand this. We are going to receive only 1,40,000 because 10,000 was already adjusted. Next, what happens? First call or final call, whatever it is, first call account debited to equity share capital, 5,000 shares into 20. Now we'll go and check what has happened is the calls were duly made on 1st July and 1st August respectively. One shareholder did not pay the first call money of 150 shares, which he paid with the final call together with interest of 5% per annum. Another shareholder holding 100 shares did not pay the final call money till the end of the accounting year, which ends on 31st October. Now, 150 shares he has not paid now, he has paid later. Correct. So can you see over here? Only 4,850 shares. You got the money. 4,850 into 4,850 into 20. 97,000 you got. Now, when we go to final call, again we'll make the final call. Calls in areas account debited. This time they have not maintained consistency. Some places they are creating calls in areas, some places they are not creating calls in areas. So calls in areas account debited to equity share first call. Okay. That is basically 150 shares into 20, 3,000 you have transferred to calls in areas, no problem. Now 5,000 shares into final call is 30, 1,50,000 due entry. This should be little down. Equity share final call to equity share capital. Now, what is happening is that person is paying you the interest also and paying the money who had not paid that time. So if you notice over here, the last date for payment was 31st July and here it is 31st August. Okay, that means that 1 month is the time period for final call. Now if you notice, 3,000 rupees calls in arrears into 5% divided by 12 into 2. 25 rupees they have taken. 2 months. Is it 2 months or 1 month, guys? Last date fixed for payment is 31st July. First call. Last date fixed for payment is 30th August. The final call. Okay. Paid with the final call together interest of 5%. Should have been 1 month. They've taken it as 2 months. Okay. Don't worry about the amount. Just calculate and see the entry. It should be only 1 month. The last day to pay was 31st July. Here the last day to pay is 30th August. He's paying everything. No. He's paying along with the final call. 5%. Okay. One shareholder did not pay first and he paid with the final call together with the interest. Oh, 150 shares only. See the twists here and there. 300 shares were actually the situation. Oh no, correct. It's 150 shares only. No. What are you telling? 300 shares. 150 shares only. It's 150 shares, guys. Okay. 150 shares, but 5%. See, 150 shares into 20, 3,000 into 5% divided by 12. 1 month only interest. Don't take it for 2 months. It should be 1 month. 12.5. Clear? Then calls in arrears account debited to equity share. Final call. Calls in arrears debited to equity share final call. This is a separate person, not that same person. One person who is having 100 shares into 3, okay, into 30, that person has not paid. So that initial person has paid. Don't worry about that. Now shareholder account debited. So again, they're again calculating for 2 months. I don't know what's the logic here. This might be 2 months because the year ends right on 31st of October. So July means August, September, October. Okay, they messed it up, guys. This should have been 3 months, no? July, August, September, October, 3 months interest. Here they've taken 2 months interest again. Okay, so be careful with the dates. And all the receipt entries are there. Equity share final call. Everybody paid except that 4,900. And the call scenarios, initial call scenarios, we got the money this time. Interest also, we got interest amount is wrong. It should have been 12.5. Be careful with that. And then balance will obviously change because so many wrong numbers are there. Okay, that should be, just be careful with the amounts. They have gone wrong with the calculations. All 2 months, 3 months and all, they've messed it up. Okay, so just be careful there. Now, here, B. M Limited Incorporated on 1st April issued a prospectus inviting applications of 5 lakh shares. The issue was fully underwritten. ABCD. Okay, so gross liability, we start with gross liability. Can you see the gross liability here? Gross liability. Then, after that, what did they tell? The applications are received for 4,50,000 shares on which marked applications were as follows. Marked, all the marked applications, you can just transfer it over here. Marked applications. Okay, you are getting negative. They are keeping the negative ones only, they are going to adjust it. Now, then they said, calculate the liability of the individual underwriters in each of the following cases. Unmarked applications are apportioned in the ratio of gross liability, or unmarked applications are apportioned in the ratio of gross liability minus marked applications. First of all, how much is the unmarked application now? 5 lakh minus 220 minus 90 minus 110 minus 10,000. 70,000 is the unmarked applications. 70,000. So now what happens? Okay. Can you see 70,000 unmarked applications? 1 second. Is it 70? I think I got wrong. I missed my calculation, guys. It should have been Okay. See over here, guys. Total applications received is 4,50,000. From this, you subtract, and subtract. You'll get 20,000 applications. 20,000 applications are unmarked applications. Okay. Unmarked applications in gross liability ratio, not 70, sorry. Okay. 20,000 is the unmarked application. In gross liability ratio, that is this ratio only. Okay, you will get deficit. That deficit you will just apportion between the others. Okay, here what they are doing, whatever ratio comes over here after removing the marked applications in this ratio, that means this fellow has gone into negative. No, so for him nothing. Okay, this fellow has gone into negative, so for him nothing. So whatever remaining ratio is there, it's going to be just distributed between the two people. Can you see? Only two people are taking over the unmarked applications because this fellow also has become zero. This fellow also has become zero because of the negatives. Okay, so it is going to be distributed in this ratio of 37,500 and 32,500. So whatever is there in that ratio, they are going to distribute. Clear? That should be it, guys. Simple question. Next, 6. Okay, next we'll go further. This one is June 2025, set 1. Let's have a quick look at that. Okay. Priyanka Industries has an authorized capital of 2 lakh divided into 100 each. Of these, 600 shares were fully paid up on payment of machinery purchased by Z Limited. 800 shares were subscribed by the public and during the first year, 50 per share. I think we have seen already this question. Same question was there. Okay, but we'll have a look at it again. See, give journal entries recording the above transaction, including cash transaction, and prepare balance sheet of the company in accordance with Part 1 of Schedule 3 of Companies Act. They want you to prepare balance sheet also. Now, over here, the money received in respect of these shares were as follows. Full amount called up. Okay, only 40 per share, 30 per share, and 20 per share. Directors forfeited 75 shares on which less than 40 per share had been paid. Less than 40 per share had been paid. So these two are forfeited. Now let's have a look at the question. First, machinery accounts debited to Z Limited to share capital. This is the shares issued to vendor. Now shares issued to vendor is sorted. Now after that, what you're going to do? After that, you can see over an authorized capital of 2 lakh divided into shares of 100 each. Of these, 600 shares were issued as fully paid for payment of machinery purchased from Z Limited. 800 shares only we are giving to public. So 800 shares, you have to be little careful. Okay. And during the first year, 50 per share was called up and payable. 20 application, 10 allotment, and 10 first call, and 10 on second call. So 20, 10, 10, 10. Only 50 we are going to talk about. Remaining we are not going to talk about at all. Okay. Now, application, bank account debited to application 20. So 800 shares into 20. This makes this. Everybody paid application money. Share application to share capital. Now allotment, 10 rupees. 800 into 10. Equity share allotment to equity share capital. Did everybody pay allotment? No. Someone has missed the allotment amount. Because can you see this fellow has paid only 20 rupees per share. They have missed the allotment amount. So this is going to be 775 into 10. This is going to be 25 into 10. Calls in arrears to allotment. Next, we make the first call. First call will be again 800 into 10. 8,000. Then, who is not paying now? Can you see this fellow has paid only 30 rupees per share. That means he is not paying first call. So 75 shares, we are not getting the money. So this is going to be 725 into 10. And here 75 into 10, we are not getting the money. So calls in arrears debited to equity share first call. Final call will again make for all the shares 800 into 10, 8,000. Now who is not paying the final call? This person is not paying the final call. So 75 plus 125, 200 shares, we are not getting the final call. So now here it becomes, this entry will be 600 into 10. Only 600 shares they are paying. 200 shares they are not paying. 200 into 10. Now we are going to forfeit, but we are going to forfeit only the 75 shares who have paid less than 40 rupees per share. So 75 shares we are going to forfeit. So this is going to be 75 shares into 10. 75 shares into 50. 3750 to forfeited shares account, share forfeiture account or forfeited shares account. Okay, 50 shares they have not, they have paid 30 rupees, and 25 shares they have paid application money. So this is the amount which is transferred to share forfeiture account. And then calls in arrears 50 shares. Okay, did they interchange the numbers? Okay guys, see, 50 into 20 it should be, and 25 into 30 calls in arrears. 50 into 20,000, and then 25 into 30 is 750. So that's how they got the 1,750. They've missed the numbers there. So that should be shared forfeiture. They did not talk anything about reissue and all. Now what will you do when you are preparing a balance sheet? Now see, shareholders fund, share capital. See how share capital note looks. Okay, authorized capital we know. Issued capital 1,400 shares into 100. We issued to vendor also. Okay, subscribed capital you see over here, 600 shares into 100 fully. 725 shares, because 75 shares have been forfeited here. 725 shares you get 9. Then calls unpaid minus, basically it's calls in arrears which is subtracted, and add the forfeited shares. Forfeited shares, how much we had? 2,000. Can you see over here? We had 2,000 in forfeited shares. See, to share forfeiture 2,000. This 2,000 is going to be added. So called up capital minus your calls in arrears plus the shares forfeited, that you're going to add back, and that is when you're going to get this number. Okay, machinery we know, PPE. This is cash and cash equivalent. Okay, cash at bank 37,000. That shouldn't be a problem. Okay, small balance sheet they have asked. Next, we go into the next question now. B. Prepare debenture redemption fund and debenture redemption for 4 years. We have already seen this question. You can do it on your own. That should be it. Again, same thing. See, 4.641. Same question they have repeated. Next, let's go further. Okay, next, 2A. Journalize the above mentioned transactions. Share issued capital of KGF Limited consists of 50,000 equity shares of 10 each fully paid. The company offers to its shareholders shares on right basis in the ratio 1:1. The shares of 10 each being offered at a premium of 10 per share. Half of the price was payable with the application, and balance was payable on allotment. Distribution being as follows. Now with the application 5, on allotment 5. Share premium. Okay, application you pay half premium, and allotment you pay half premium. All the shareholders accepted the offer. One shareholder holding 150 shares paid the full offer price with his application. Another shareholder holding 100 shares failed to pay the allotment money, and his shares were subsequently forfeited. Later the shares were reissued at 2,000 rupees for 2,000 rupees cash. Journalize the above mentioned transaction. So what we have to understand in this question, there is calls in advance also. Now application stage there is no problem. Okay, 50,000 shares. Now bank account debited to, they have paid full amount with application. They could have avoided this calls in advance here, but okay, it's there. See, bank account debited 50,000 shares. How much is the application money? 10 rupees with premium 10 rupees. So 5 lakh plus that one guy who has paid entire amount. How many shares he has? 150 shares paid the full amount. So 150 into 10 rupees. Extra 10 he has paid, even the final this thing. So therefore it becomes 5,01,500. To equity share application account, to calls in advance. Calls in advance 150 into 10,500. Clear, calls in advance recorded. Now equity share application account debited. Remove the money from there. Transfer to share capital, but it will be 50,000 into 5 share capital, and 50,000 into 5 will be securities premium. So that should be sorted. Now make the allotment call. Allotment call when you're making, again 50,000 into 10, but out of that 5 goes to share capital and 5 goes to securities premium. So sorted. So now here there is a problem. 150 shares he has already made the payment. 100 shares he is failing to make the payment. So now 50,000 shares minus 150 minus 100 into 10. 150 it is So 50,000 minus 150 minus 100 into 10, 4,97,500, because somebody has already paid early, somebody is not going to pay. So now calls in advance was 150 into 10,500. To equity share allotment account, it's going to be 49. See, allotment, how much we are going to get? The 150, fine, we got it. Okay, but 100, 50,000 minus 100, that fellow is not paying. So 50,000 minus 100, 49,900 into 10, 4,99,000, because that is calls in arrears. They could have added calls in arrears. I told you they are not following consistency. Now equity share allotment account debited. This is what a mess of an entry. Look at this entry, guys. Forfeiture entry. Isn't it equity share capital account debited? Equity share allotment, it seems. Equity share capital account debited. 100 shares we are forfeiting. 100 shares. Okay, face value is 10. Now that fellow has not paid the premium. Application premium he has paid. Allotment premium he has not paid. So 100 into 5. Okay, equity share allotment 100 into 10. 5 plus 5. 2. Share forfeiture. Okay, or forfeited shares account 100 into 5. 100 into 5. I hope you are getting this. Okay, 10 is a face value. Okay, 10 is a face value. But what we are transferring over here, the only, see, in this what happened is securities premium received also is there, securities premium not received also is there. Application stage they have received securities premium, ignore it. Allotment stage they have not received securities premium, that you are going to reverse. So that is getting reversed over here. What is this 5 which is going into share forfeiture? The 5 rupees which you have paid on application face value, that is getting transferred. Clear? Then it is reissued for 2,000 rupees. Directly they have told bank account debited 2,000, equity share capital. Okay, 100 into 10 and balance will go to securities premium. So whatever you have here in share forfeiture, transfer it to capital reserve. Did you understand this, guys? See, what has happened here is 100 shares forfeited. Okay, in this application 5 face value and 5 is securities premium. This is received. So ignore it. And allotment, okay, 5 is face value and 5 is securities premium. 5 is securities premium. So what happens now over here when 5 is face value and 5 is securities premium, this is fully not received. So this premium we are going to reverse. This premium we are not going to reverse, we are going to ignore it. So basically 10 plus 5, we are only going to talk about 15 rupees in this forfeiture entry. Clear? Yes. Next. D and Co issued 5,000 shares of 20 per share. Entire share was underwritten as follows. The firm underwriting was 500, 250 and 250. Shares applied were 4,500, including firm underwriting. Marked applications were also given. Calculate the liability of each underwriter. Okay. See, gross liability, we know it's given in the question. First, unmarked applications. Okay. Except the firm underwriting, they have subtracted everything. Unmarked applications in the ratio. Marked applications directly given. Remaining liability. That oversubscription is basically negative. Negative, we are going to always set it off. Then firm underwriting, finally we add it. That time you get our total liability. Okay. Total liability we'll get. It cannot be 593.5 because it's shares, guys. Don't keep 593.5. What logic? How can you keep fractional shares? Okay, that's it. Now we go into the mock test paper which they have announced for your particular attempt. Okay, past journal entries. X Limited issued 10,000 equity shares of 10 each at a premium of 2 per share, payable as 3 on application, including premium of 1 per share, 4 on allotment, including balance of premium. So 1 rupee premium is at application stage, 1 rupee premium is at allotment stage, and the balance in call. So let's keep it this way. If I take it as application is going to be 3, right? So 2 plus 1 rupee premium. Allotment is going to be 4, right? So 3 plus 1 rupee premium. So call is going to be 5 rupees. So this becomes 10 plus 2 rupees premium. Okay, public subscribe for 12,000 shares. Excess application money was refunded immediately. One shareholder, Mr. A, holding 50 shares, paid the call money
along with allotment money. Another B, failed to pay the allotment and call money. So 50 shares we got calls in advance, 30 shares we did not get the money itself. Okay, this should be, you should be a little careful here. So see, bank account debited to equity share application 12,000 into 3. 12,000 into 3, so that makes it 36,000. Now, refund of excess application money. 2,000 you are refunding, so 2,000 into 3, application account debited to bank. Done, finished. Now, when you are transferring, what you have to be careful about, equity share application account debited 10,000 into 3, that goes to share capital. Okay, only 2 rupees should go to, only 2 rupees should go to share capital and 1 rupee should go to securities premium. I hope it's clear here. Now, allotment due. Allotment due, you see, 4 rupees is allotment money, 3 rupees is share capital, 1 rupee is securities premium. This is what we have discussing. Now, when we are talking about allotment money received, okay, allotment money received. So, here you have to be a little careful. See over here, out of 10,000 shares, this guy who is having 30 shares is not paying the allotment money. So 10,000 minus 30. That's why they have transferred 9,970 full. Okay. Now calls in arrears, what we are going to do, 30 into 4 will be considered as calls in arrears and remaining goes to equity share allotment. Now somebody had paid even the final call amount. That is the person who is having 50 shares. So bank account debited to calls in advance. They have separated it so that there is clarity. Okay. Now call amount due. Full you make the call. 10,000 shares into 5 final call you make. Now who will not pay you? Out of 10,000 shares, the guy who has paid calls in advance, he has already paid, he will not pay you. And the guy who is not going to pay you is calls in arrears, he is also not going to pay you. So only 9,920 into 5 you are going to get the money. 2, calls in arrears again debited. Calls in advance debited because he has already paid. Calls in advance is liability reversal. Calls in arrears is asset creation. Okay, to equity share first and final call. Forfeiture, they said the shares are going to be forfeited. Okay, of these forfeited shares, okay, 25 of these shares are reissued. 25 of those shares are reissued for 9. How many shares are going to be forfeited? 30 shares. 30 shares we are going to forfeit. So 30 shares into 10. Application wala premium he has paid. Only allotment wala premium he has not paid. So 30 into 1. Only allotment premium. Calls in arrears, what he has paid? Only application. He has failed to pay the allotment and call. So calls in arrears, you see 30 into basically 9 rupees he has not paid, 270, and share forfeiture 30 into 2. What is this 2? 1 rupee of application and 1 rupee of premium which was there at application. Okay, reissued 25 shares, 25 into 9, 225, 25 into 1, shares forfeited, to share capital 250. Okay, now 2 minus 1. Why 2 minus 1? 2 rupees we made profit when we forfeited, 1 rupee is the loss. So 2 minus 1, this will be transferred to capital reserve. That should be it. Okay, unmarked applications as a portion on gross liability and gross liability minus marked application. This we have seen already in one of the earlier questions. I'm skipping that one. Yes, next we'll go into 9. Ninth mock test paper that we are seeing. This is the one which is for our recent exam. GH Limited issued 5,000 equity shares of 10 each at par, payable 2 per share on application, 4 per share on allotment, 4 first and final call. The shares were all subscribed and all money due was received. One shareholder holding 200 shares paid the call money along with allotment money. The amount was subsequently adjusted. Give the journal entries to record the above transactions. That's it. One shareholder holding 200 shares paid the call money along with allotment money. Simple. 2 rupees application, 4 rupees allotment and 4 rupees first and final call. Now, how many shares we have? 5,000. So bank account debited 5,000 into 2, application amount received. Application amount transferred to share capital. Now allotment call 5,000 into 4, make the call. Then received the allotment money. Now see over here, allotment money received 5,000 into 4. Now one person who had 200 shares paid even the call money. So it becomes bank account debited to calls in advance. 200 into 4. The first and final call 5,000 into 4. But out of that 5,000 shares, 200 they have already paid the money. So 4,800 into 4. Then calls in advance is reversed to share and first and final call. Done, finished. Okay. We have one more here. RPS Limited has 12% redeemable preference shares, share capital of 50,000 consisting of shares of 100 each, fully called up and paid up. Company wants to redeem them at 10% premium. Company wants to redeem them at what? 10% premium. Ledger shows the following. Securities premium 2,000, P&L 10,000. Company wants to make a minimum fresh issue of shares of 10 each at 5% premium for redemption of preference share. Ascend in the amount of fresh issue, pass necessary journal entries. Okay. Now we have a redeemable preference share capital of 50,000. Okay. The company wants to redeem at 10% premium. Now have a look at this. 50,000 plus 10% premium, that means 55,000. Okay, we have P&L में 10,000 and securities premium 2,000. So 43,000 is required. Divided by 10.5 because the shares are going to be issued at 5% premium. You get 4095 shares. Simple. 4095 shares. So 4095 into 10.5. Okay, this amount is for share issue to equity share capital to securities premium. Just round off the decimal points. Then securities premium account debited, P&L debited to premium on redemption of preference shares. First only premium they are going to set off. Okay, then preference share capital, premium debited to preference shareholders to bank payment entry. Finally, you have to create CRR. 10,000 minus 952. 952 went over here. Remove that and transfer it to CRR. 9050. You're going to transfer. See, 40,000. Basically, if you want to keep it very simple, instead of this ulta-pulta calculation, 50,000 was the face value of preference shares that are redeemed. 40,950 was the face value of equity shares. So that means 950 rupees we have to transfer to CR. Done. Finish. With that, we are done with our chapter number 1 discussion. Next, we'll go into preparation of financial statements. Yes. Let's go into the next chapter, which is a very important chapter. Every time they're asking 14 marks from this particular chapter. Okay. Preparation of financial statements. Preparation of financial statements of the company. Okay. First, I'm going to just discuss some important topics of preparation of financial statement. Format, obviously you have to know the format. And every single question, I will discuss the adjustment, okay, and the items which are there in the trial balance. What I'm not going to do is look at the solution, what they have done, because there are a lot of times the institute makes different presentations, okay, randomly different presentations. So what I would suggest is just follow my discussion over here for financial statement. 14 marks you can score. Just follow the consistent presentation, okay? Yes. Preparation of financial statements of companies. First one, revenue from operation. If it is revenue from operations, okay, that means it is revenue directly from business activity. Okay, and other income is anything other than direct business activity. Clear? Revenue from business indirectly. Example, if a furniture dealer has sale of furniture, that is revenue from operations. But if he sells his old newspaper, that is other income. Or even profit on sale of his old computer is also other income. Cost of material consumed. This is for when they tell consume, you can only consume raw material. So this is cost of raw material used for the manufacture. Opening stock of raw material plus purchases minus closing stock of raw material. If there is any freight inwards and all direct expense, that also can be added over here. Now, purchase of stock in trade. That is when you are involved in trading business. Directly the purchase of stock in trade will be taken as an expense. Clear? Changes in inventory is difference between opening stock. See, opening stock minus closing stock. But of WIP, finished goods and stock in trade, not raw material, because raw material opening stock minus closing stock is happening over here only when you're calculating cost of material consumed. Clear? Now, if opening stock minus closing stock is positive, that means it is expense. If opening stock minus closing stock is negative, that means it is income. If closing stock is higher than opening stock, what you will do is in changes in inventory, you will show it as a negative figure. Okay, non-current. Whenever they use the word non-current, that means long-term, greater than 12 months. Current is short-term, that is up to 12 months. Capital work in progress is when there is a building which is under construction, that is called as capital work in progress. Once it is completed, that is considered as property, plant and equipment. Now, income tax. Okay, you have to be a little careful with income tax. Imagine you have provision for tax 200. Advance tax paid is 150. That means tax payable is how much? 50 will be your provision, which is liability. Provision for tax is 200. Advance tax paid is 230. That means 30 is refundable. That means it becomes asset for us because we have to receive it back from the government. Now, provision for tax is short-term provision. It will be shown as liability. Advance tax is short-term loans and advances, or you can also show it as other current assets. Other current asset is also fine. Tax paid will be tax expense in the P&L. Okay, remember in your financial accounting, you have studied about AS 22, where tax paid consists of deferred tax and current tax. Okay, you have to know the format, refer the format. Now, what I'm going to do is I'm going to discuss every single problem of last previous exams and the model test paper, and I'm going to tell you where it should go. Just follow that blindly, you will get the marks. Okay, because there are a lot of errors, I'm not going to pinpoint at the solution and discuss. I'm going to discuss it on my own. Now, see over here, you are required to prepare statement of P&L for the year ended 31st March 2023 and balance sheet as at that day after taking into consideration the following information. They asked you to prepare what? Statement of P&L, and they have asked you to prepare balance sheet. Now, closing stock is more than opening stock by 90,000. Now, go to the question and see what stock is given in the question. Okay, stock, opening stock. They have given opening stock. So what did they tell now? Closing stock is more than opening stock by 90,000. Therefore, what is the closing stock? If opening stock is 10,000, closing stock should be 1 lakh. Closing stock should be 1 lakh. And now what happens in this over here is, in balance sheet, changes in inventory, you are going to show, sorry, not balance sheet, in P&L, changes in inventory, you are going to show 90,000 negative. 90,000 negative. Okay. And in balance sheet, you will show closing stock as 1 lakh. Closing stock will go under the heading of inventory. Inventory will show 1 lakh. Okay, if at all we want to just verify this point and see if they have shown like that. See, this is why I am telling I will discuss individually. See what they have done. This is P&L. Do you think you'll get 14 marks for this, guys? This is your P&L. Total revenue, total expenses. That's it. Okay. So what I'm going to do is I'm going to discuss on my own. Next. So changes in inventory will show 90,000 negative, and balance sheet will show inventory as 1 lakh. Now provide for doubtful debts, make a provision for income tax, depreciation expense includes 8,000 and 12,000. Directors proposed dividend. Proposed dividend you're going to ignore because only if dividend is declared as per schedule 3 and paid, then you're going to show it. Transfer to general reserve 10,000. Now one by one we will discuss all the items. Building will go into property, plant and equipment. Machinery will be property, plant and equipment. Okay. Now depreciation, okay, expense includes, that means already depreciation entry is passed. This is outside the trial balance. Now they are not going to ask you to pass a depreciation entry. Can you see there is already depreciation over here 20,000. Now what will happen? Depreciation 20,000. Out of this they are telling that 8,000 is on building and 12,000 is on machinery. So 8,000 depreciation on building and 12,000 is on machinery. 8,000 on building and 12,000 is on machinery. So what you are going to do when you are preparing the depreciation and amortization, you are going to show this separation properly. Okay, you don't have to reduce from asset because it's already in the trial balance. That means it is already entry passed, already reduced from asset. And in fact, they have provision for depreciation over here. So it is already added to the provision. Now, opening stock. What will happen to opening stock? Nothing. Just it will go to changes in inventory in the trial balance. Loose tools, property, plant and equipment. Purchases, you can show it as purchase of stock in trade. Salaries, employee benefit expenses. Directors fees goes into other expenses. Rent, other expenses. Depreciation we have discussed. Bad debt. Whenever you get this bad debt right, go and check, do we have a provision for bad debts? Yes. Can you see there is a provision over here 3,000 and there is an adjustment. They said provide for bad debt 4% on debtors. Now what we are going to do is go and check how much is my debtor balance. Debtor is 1,25,000. So 1,25,000 is the debtor balance. Clear? Now there is no bad debt outside the trial balance. This is our financial accounting regular question. 1,25,000 is the debtor balance. Okay, they said provision should be how much? 4% on debtors into 4%. 1,25,000 into 4%. This gives us 5,000 is the provision required. 5,000 is the provision that is required. If 5,000 provision is required, here what is there? Bad debt 6,000. Bad debt 6,000 will be taken. Whenever there is bad debt, it will be taken from provision. How much is the provision? Provision is only 3,000. Therefore, bad debts 6,000. Provision for doubtful debts which is there is 3,000. So, remove 3,000 from here and balance 3,000 debited to P&L. So bad debt which cannot be adjusted with provision, that will be debited to P&L. So provision became 0. Now 5,000 is a provision to be created. So in P&L you will show this as other expense, and in balance sheet this will be subtracted from trade receivable, minus from trade receivable. I hope it's clear. And this bad debt 3,000 which is going to P&L, this will all be shown as other expense, and provision this is already adjusted. So 3,000 bad debt will be in other expense, and 5,000 provision is going to go to other expense, and 5,000 is also going to be reduced from debtors. Okay, so with that the closing stock adjustment and provision adjustments are done and discussed. Now we go further. Bad debt, 3,000 will go to other expense in the P&L. Investment, you can take it as non-current investment. Whenever they don't tell you anything about investment, take it as non-current investment. Interest accrued on investment, interest accrued, interest receivable. That means other current assets, receivable. Debenture interest. Okay, finance cost, you will show it as finance cost. Now, advance tax. Advance tax, you can show it as short-term loans and advances, or you can also show it as other current assets. Sundry expenses will go into other expenses. Debtors, we already know it will go to trade receivable. Bank will go to cash and cash equivalent. Clear? Next, we go into the further portions. Sales will go into revenue from operations. Outstanding expense put it into other current liability. Provision we already discussed, minus from trade receivable, not the 3,000, the 5,000 provision that we created. Okay. Equity share capital is share capital. Okay. Under shareholders funds, you have share capital and reserves and surplus. Share capital. General reserve is reserves and surplus. P&L is also reserves and surplus. Creditors 92,000, trade payable, provision for depreciation. Okay, all this what we will do, it will be subtracted from PP. In the PP note, you are going to subtract respectively 14% debentures, long-term borrowing, interest accrued on debentures. Now just check 2 lakh into 14%. Are you getting 28,000 debenture interest? Yes. But out of that 14,000 is interest accrued on debentures but not due. Interest accrued, that means receivable, but we have not received it because due date has not arrived. So other current liability. Dividend received it is other income. Okay, unclaimed dividend. We gave the dividend, people didn't come to collect it. Other current liability. Okay, this much. Now these two adjustments. Make a provision for tax. Whatever you get no profit before tax in your P&L, on that you calculate 30%. That will be your provision for tax. Remove that 30%. And provision for tax, you show it under short-term provisions. Depreciation is also sorted. Directors, now when you get this, after you remove this provision for tax, you will get the profit, right? Profit is usually transferred to reserves and surplus. When you transfer the profit to reserves and surplus, it should go to P&L. From that, 10,000 what you will do, in reserves and surplus, minus from P&L 10,000, and add it to general reserve 10,000. This is going to be your solution. Is this clear, guys? Yes, this is your December 2023 question, which I have just discussed. Now I'm going into June 2024. See, they're giving the solutions randomly. Is this even the format? No, you have to follow proper schedule 3 format with the notes. So that's why I'm directly discussing the answers. Now, You are required to prepare statement of P&L and balance sheet as on that day, taking into consideration the following items. Okay. Closing stock is given 31st March 2022, 3,52,000. Always you have to go and check that time. Opening stock is inside the trial balance. Okay. So 3 lakh is opening stock minus 3,52,000 is closing stock. Therefore, 52,000 will be negative. This will go to changes in inventory. This will go to changes in inventory. And 3,52,000 closing stock will go to inventories. 3,52,000 closing stock will go to inventories in the balance sheet. Clear? Now, this where will it go? Changes in inventory. It will go to changes in inventory. Clear? Now, next one, make a provision for income tax. You already know this. We have seen this adjustment. So, when you get your PBT, okay, on that minus provision at the rate of 30%, that time you will get your PAT, whatever the number is. This PAT will go to reserves and surplus. In reserves and surplus, P&L. Now this 30% what you have created, it will go to short-term provisions. It will go to short-term provisions. Clear? Now depreciate plant and machinery 15%, furniture 10%, patent 5%. They are asking you to depreciate. That means depreciation is not done. So we have to do it. What will be the treatment for this? Percentages, you know, you already take the percentage and multiply. The treatment for this will be, okay, plant and machinery and furniture. The treatment will be, it will go to depreciation and amortization and PPE respective asset minus. Okay, patent, it will go to depreciation and amortization. In intangible asset minus. Clear? I hope you're getting this adjustment. Now, outstanding rent 3,200 and outstanding salary 3,600. What will you do with this? Add it to the respective expense and then show it as other current liability in the balance sheet. Add it to the expense and then show it as other current liability in the balance sheet. So, directors recommend a dividend of 15%, including interim dividend after transfer to general reserve. Recommend and all, we are not going to worry about. Only if it is paid, we are going to pass the journal entry. Clear? Transfer to general reserve 8,000. What will you do? In reserves and surplus, P&L minus general reserve plus. Clear? Provide 2040 for doubtful debts. They are only telling you directly, provide for doubtful debts directly. Now you have to check whether there is any provision already in the question. Okay, there is no provision. That means directly what we are going to do for this provision. Okay, other expenses you are going to show 2040 and from trade receivable you are going to subtract 2040. Authorized capital of the company is 8 lakh divided into 80,000. Okay, authorized capital, what will you do? In share capital note, you just show the authorized capital, of which 40,000 shares have been issued and fully paid up. Okay, that is the called up and paid up capital. Notes to account should form part of your answer, but in our suggested answers, there is no notes to accounts, guys. Okay, they have directly done. That's why I told, we'll not look at suggested answers. Understand where each item will go and prepare your balance sheet. Now, purchases. Purchases will go into purchase of stock in trade. Salaries, employee benefit expense. But remember, outstanding salary has to be added. Freight and carriage. Freight and carriage, you can show it as other expenses. Furniture, property, plant and equipment. Remember, there is depreciation. Contribution to PF, employee benefit expense. Rent, rates and taxes, other expenses. Stationery, other expenses. Repairs, other expenses. Insurance, other expenses. Miscellaneous, other expenses. Interim dividend paid. Now, what will you do? Interim dividend paid in reserves and surplus minus. Reduce it from P&L or reduce it from general reserve. Okay. Staff welfare expense, employee benefit expense. Plant and machinery, property, plant and equipment. Remember depreciation. Cash and bank, cash and cash equivalents. Patent, intangible asset. Remember that amortization. They have asked you to subtract. Trade receivable is trade receivable, but remember the provision for doubtful debts. Yes. Now, purchase returns. What will you do with purchase returns? Here only there is purchase. Reduce from purchases. Sales is revenue from operations. Discount received is other income. Balance in P&L will go to reserves and surplus. Okay, adjustments, you already have discussed this. Share capital is share capital. Trade payable is trade payable. General reserve will go to reserves and surplus. That should be it with this particular question, which was asked in June 2024. 14 marks into the pocket, guys. Just focus fully and solve all these questions, whatever we are discussing. No, somewhere here and there, they'll mix and ask one question. June 2024 done. December 2024. I just want to see if they have given fully. Okay. For a change, they have given full solution in December 2024. Okay. But I'm going to discuss directly. Now, see over here, closing stock is more than opening stock by 9,60,000. Okay, we'll go and check. Directly closing stock is in the trial balance. Whenever closing stock is directly there in the trial balance, that means purchases are already adjusted. Purchase is already adjusted for opening stock and closing stock. So now this point we are going to ignore. We don't have to do anything. Directly this closing stock will go to balance sheet as inventory. Nothing, no changes in inventory because already it is adjusted. When closing stock comes into the trial balance, that means opening stock, closing stock are already adjusted with the purchases. Can you see purchases adjusted over here? Yes. Now what will you do? This purchase will go to purchase of stock in trade. Clear? Now, provide for doubtful debts 4% on debtors. This we have to check. Do we already have one provision? Yes. With bad debts, we have to analyze this. This is done. Make provision for income tax. This we have already seen. PBT, whatever you get, make 30% provision. And that provision should go to short-term provisions. Okay. And PAT will go to reserves and surplus. Depreciation expense included depreciation of 96,000 and 1,44,000. Included means that is already done. Go to the trial balance and see. Can you see depreciation over here? 96,000. And 1,44,000 already it is included. So 96 plus 144, you're getting 2,40,000 depreciation. It's already there. Directors proposed dividend at the rate of 25%. Proposed dividend ignore. General and transfer to general reserve 10%. Transfer to general reserve 10%. 10% already we know what we are going to do. 10% of what? PAT into 10%. Whatever you get PAT into 10%, that amount, okay, from P&L minus and from reserves and surplus plus, general reserve plus. All this is going to happen in reserves and surplus. Bills discounted but not yet matured. Not yet matured, no, it's a contingent liability. Contingent liability will be shown as a footnote. As a footnote in the balance sheet. Authorized capital of the company is 60,000 equity shares of 100 each. Authorized capital, just in your share capital note, show the authorized capital separately. Clear? So everything is done. Only thing that we have to worry about is the doubtful debts point. Now let's go further. Buildings, property, plant and equipment, nothing to be subtracted. Only provision for depreciation is there over here. Like our not previous to previous question, PPE minus. Machinery, PPE. Okay, loose tools also take it as PPE. Now, purchases adjusted. Done. Salaries, employee benefit expense. Directors fees, other expense. Rent, other expense. Depreciation is depreciation and amortization. But the breakup is over here. Bad debt, 72,000. What will you do now? Now, this is again same thing. See, bad debts, 72,000. We already have provision for doubtful debts, 36,000. Can you see provision for doubtful debt, 36,000 over here? Yes. Out of 72 minus bad debt, 36,000. Provision became 0. So here 36,000 adjusted. So remaining 36,000 of bad debt will go to other expenses. 36,000 you adjusted, 36,000 you could not adjust. It will go to other expenses. Now what you are going to do, apart from that, now take your debtors. How much is your debtors? 15 lakhs. 15 lakhs into, they asked you to create a provision for doubtful debts at the rate of 4%. 15 lakh into 4%. So 15 lakh into 4% gives you 60,000. 60,000 provision you have to create. This provision existing already became 0. So 60,000, what will you do? P&L other expenses, and in balance sheet trade receivable minus. Bad debt you don't have to minus from trade receivable. It's already done. This is the second or third time we are seeing this. Okay. Now bad debt done. I told you 36,000 in this will go to other expense in the P&L. 10% investment. You can take it as non-current investment. Interest accrued. This is just like previous to previous question. Interest accrued on investment. Okay, you can take it as interest accrued, other current asset, debenture interest, finance cost, advance tax, other current asset. You can also take it as short-term loans and advances, sundry expenses, other expenses, bank, cash and cash equivalent. And here we have sales, revenue from operations, outstanding expense, other current liability. Okay, equity share capital, general reserve, reserves and surplus, P&L, reserves and surplus. P&L is also reserves and surplus. 31st March 2024, that is opening balance. You will have to add the profit, remove from there, transfer to general reserve. All this you have to do. Trade payable, creditor is trade payable. Provision we have discussed, 14% debentures. Now 24 lakhs into 14%. Can you see it's 3,36,000? It's already there here. Interest accrued but not due. Not interest accrued means what? Other current liability. Other current liability. Interest on investments. That means we are receiving it. Other income. Unclaimed dividend. We gave dividend, they didn't claim it. Other current liability. Clear? All this we have to understand, guys. This is your balance sheet. Next. June 2025. This was a solution, right? Now we have to go into December 2020. One second. December 24. Did we do December 24 question? I think we missed December 24. June 24. We did. Yeah. December 24, I think we missed it. December 24. Okay, we were not able to, we missed that when we were solving. So we'll do December 24 now. Okay. Now, again, I always go to the end and discuss the adjustments first. Now, closing stock was 3,50,000 on 31st March 2024, 3,50,000. So go and check inside the trial balance. Is it opening stock? Inside the trial balance, the stock that is given, opening stock. Yes, that means it is not adjusted. So what will happen to this opening stock? This will go to changes in inventory. It will not go like this. It will be adjusted. See over here. 3 lakh minus 3,50,000. That means negative 50,000 will be shown as changes in inventory. Changes in inventory. Okay. And 3,50,000 will be shown in the balance sheet as inventory. I hope it's clear. Okay. Depreciation rates. That means depreciation in this question is not provided. We have to provide motor vehicle, machinery and buildings. What will you do? Depreciation and amortization, you will show it. And in the balance sheet, PPE minus from the respective assets. Interest on debenture is payable quarterly and the last quarter's interest is yet to be paid. Okay, last quarter's interest is yet to be paid. Interest on debentures. Okay, so what we are going to do, go and check the debentures. Okay, 3 lakh. So 3 lakh into 10% into 3 divided by 12. So 3 lakh into 10% into 3 divided by 12. 7,500 is yet to be paid. So what will you do with this 7,500? 7,500, add it to finance cost and also show in the balance sheet as other current liabilities. Now, trade receivable include a sum of 25,000 due from Mr. X who has become insolvent. Insolvent means okay. And only 25 paise in a rupee is expected to be recoverable from him. Now, what will you do? 25,000 out of the 25 paise, 25% you can recover. That means 75% is bad debt. So 25,000 into 75%, 18,750 is bad debt. So 25,000 minus 18,750, 6,250 is what we can recoverable. So 18,750 we have to reduce from bad debts. Reduce from trade receivable and also show it as other expenses because it is bad debt. But do you have provision? Check in the question. Do you have provision in this question? No provision, no existing provision is there. So then they said create a provision for doubtful debts at 2% on other trade receivables. So now these people are going to pay no. So again on this there is no need of provision. No. Go and check our debtors. Trade receivable 10 lakhs. Okay, trade receivable 10 lakhs. Now trade receivable 10 lakhs. Out of that this one guy you remove 25,000. So you're left with 9,75,000. On this, at the rate of 2% you need provision. 9,75,000 into 2%, 19,500 is the provision that is required. So 9,75,000 minus provision for doubtful debts. Sorry, first of all, minus. This is a little tricky, guys. See, 10 lakhs, what you are going to do? 10 lakhs. Now you need 19,500 provision. No, 10 lakhs minus, how much is bad debt over here? The bad debt is 18,750. Remove 18,750. So 10 lakhs minus 18,750. You will get 9,81,250. Remaining 6,250 is good. So we are not creating provision for that. 9,81,250. From that minus PDD 19,500. 19,500. So this will show 9,61,750. This will be your trade receivable in the balance sheet. This 19,500 already be subtracted over here, and this will also go to P&L as other expenses. And this 18,750 is subtracted over here, and this will also go to P&L as other expense. Very important calculation. Clear? Provide for income tax 1,50,000. Directly they have told. So what we will do, when we get PBT minus 1,50,000, and that will be PAT, this will go to reserves and surplus. This 1,50,000 will also be shown as short-term provision. It will be shown as short-term provision. Clear? Directors proposed dividend of 10%. Ignore on paid up capital year ended. Transfer to be made to general reserve 1 lakh. This we already know. P&L minus general reserve plus. Okay, that should be it. Rest of the things are all straightforward from the question now. Okay, equity share capital. This will be share capital. General reserve, reserves and surplus. Remember to add it. P&L, reserves and surplus. Remember to add the PAT and remove the money for reserves, what you transfer into general reserve. Okay, next you have motor van, property, plant, equipment. Remember depreciation. Debentures will go to long-term borrowing. Next, machinery, property, plant, equipment. Remember depreciation. Building, property, plant, equipment. 12% long-term government securities. Long-term means it's going to be non-current investment. Sales, revenue from operations. This sales return, revenue from operations minus net amount you're going to take. Interest on debentures. Interest on debentures, what you're going to do? It will go to finance cost, but remember you have to add the 7,500. Purchases is purchase of stock in trade. Purchase returns, you will subtract it from this only, minus. Opening stock we already discussed. Discount allowed is other expense. Carriage outward is other expense. Rent rates and tax, other expense. Income from government securities, other income. Trade receivable is trade receivable, which we already saw the adjustments. Trade payable is trade payable. Advertisement is other expense. Bad debt, other expense. Okay, remember bad debt 20,000. This is other expense. This you don't go to reduce from debtors. This is bad debt. Only further bad debt you have to reduce. Salaries, employee benefit expense. Miscellaneous expenditure, other expense. Contribution to PF and gratuity funds, employee benefit expense. Cash at bank and in hand. Cash and cash equivalent. Done. This is our question from December 2024. Now we go into all the model test papers which are there. Let's go into model test papers, guys. This is our December 2023. Yes. We'll go into the model test paper, December 2023, set 1. Okay. Following are the details of A Limited as on 31st March 2022. Now, depreciate plant by 10%. What will you do now? Property, plant and equipment. Okay, luckily they have given working notes and all at least. You can refer this, guys. I'm going to directly solve. Okay, I'm just discussing it. Property, plant and equipment minus, and it will go to depreciation and amortization. Half year's debenture interest is due. So go and check debenture 30 lakhs. So 30 lakhs into 12% into 6 by 12. 30 lakhs into 12% into 6 by 12 is 1,80,000. 1,80,000 is a debenture interest. Can you see debenture interest paid is 1,80,000? This will go to finance cost, and this will also go to finance cost, and this will also go to other current liabilities in the balance sheet. Okay, so this done, this done. Create 5% provision for debtors for bad debts. First, we'll check whether there is already provision. Bad debts provision is there, 35,000. Okay, now we have to check whether there is bad debt. Bad debt is there, 21,000. So 35,000 Out of the 21,000, bad debt is gone. So now you are left with only 14,000 provision. So this gets adjusted with this gone. Now 14,000 is there. And now check your trade receivable. Trade receivable debtors, they said 8,70,000. So 8,70,000 into percentage, they said is 5% into 5%. So 8,70,000 into 5%, 43,500. Out of that, we already have 14,000. So 14,000 if you remove, 29,500 you have to create provision. So what will happen is 29,500, you will show it as other expense and 29,500 will be subtracted. But what is the total amount that is going to be subtracted? 14,000 which is there, 29,500 which you have created, total 43,500 will be subtracted from trade receivable. I hope you are getting this point. Extra what you created plus what was already there, total amount you are going to subtract. Clear now? After that, they said, provide for income tax. I'm not going to discuss this. Whenever you get PBT, from that you remove 35% and you transfer to short-term provision and it will be shown in the balance sheet. And only PAT will go to balance sheet. Okay. Stock on 31st March is 9,50,000. Stock over here is 7,50,000. So what will you do? 7,50,000 minus 9,50,000 is equal to 2 lakh becomes negative. 2 lakh negative, what will you do? You will show it as changes in inventory and this 9,50,000 will go to balance sheet as inventory. No final dividend is declared. Ignore. Transfer the minimum required amount to general reserve. Okay, this is a old question. There is no minimum required amount. Ignore this also. As per Companies Act, there is no minimum requirement that has to be transferred to general reserve. Ignore corporate dividend tax. Ignore. Done. Finished. Now it's all about discussion of this property, plant and equipment. Plant is also property, plant and equipment. Stock, what will happen? This will go to changes in inventory. It gets adjusted. We saw the calculation down below. Debtors, trade receivable. You know trade receivable 43,500 will be subtracted. Then goodwill, intangible asset. Intangible asset. Bank cash and cash equivalent. Calls in arrears, share capital minus. Calls in arrears, share capital minus. Okay. Now, interim dividend paid. Reserves and surplus minus. Subtract in reserves and surplus only, not in P&L. Purchases, purchase of stock in trade. Wages, other expenses. Wages, employee benefit expenses. General expenses, other expense. Salaries, employee benefit expense. Bad debt, we already discussed, it's going to be adjusted with provision. Debenture interest paid, we already discussed, paid plus payable both will get added and will be shown in finance cost. This equity share capital is share capital. Surplus is nothing but reserves and surplus. It will go to reserves and surplus. Bills payable, trade payable, creditors also trade payable. General reserve will go to reserves and surplus. That means this only surplus account which they are talking is nothing but P&L. Sales will go to revenue from operations. Done. This is your 14-mark question. Okay. Let's go further. Next, December 2023 set 2. December 2023 set 2. You are required to prepare the balance sheet. Only balance sheet. Oh, you are required to prepare. Oh, not every. You are required to prepare notes to accounts to support the preparation of statement of P&L. Yes. So here they've asked you to prepare notes also. They've asked you to prepare the P&L also. They've asked you to prepare notes again for balance sheet also and also balance sheet. Basically, they could have just told financial statement. You would have done everything anyways. Okay. So let's go and check what has happened over here. Stock on 31st March 2022 was valued at 98,000. This is the closing stock. Now you have to check in the trial balance. What stock is given in the trial balance? Opening stock. Very good. So 1,60,000 minus 98,000. This gives you 62,000. This 62,000 will go into changes in inventory in the P&L. And this 98,000 will go to inventory in the balance sheet. This 1,60,000 already we have discussed. We don't have to worry about anything. Depreciate plant and machinery, furniture and fittings at 10%. Depreciate. They're asking you to do it. So property, plant and equipment, you're going to minus it. And depreciation and amortization, you're going to show it. On 31st March 2022, outstanding rent amounted to 800 while outstanding salary. I think we had this in one of the previous questions also. So what you're going to do, outstanding rent, add it to rent, add it to salary. Then outstanding will also be shown as other current liability. Other current liability. Make a provision for doubtful debts at 5%. Okay, this one. And provision for tax we already discussed. Okay, we will show it as short-term provision, and then from PBT in the P&L minus. Directors proposed dividend of 10%. I'm going to ignore it. Actually, dividend paid only should be recorded, so ignore that. 10,000 to general reserve we already discussed. Reduce it from P&L and reduce it from general reserve as well. Now what you're going to do, provision for taxation is to be made at 30%. Provision for tax at the rate of 30%. Now that we discussed, provision for doubtful debts 5% we have to see. Now doubtful debt provision, yeah, purchase and sales will be subtracted. This is purchase of stock in trade. Sales, do we have sales returns? No, we can't find. If you find sales return, you'll have to subtract revenue from operations. Now carriage inward. Carriage inward, what you can do, you can show it as other expense, or you can add it to purchase of stock in trade. Wages, employee benefit expenses. Salary, employee benefit expense. Remember, outstanding salary is there. Discount received, other income. Furniture and fittings, property, plant and equipment. Depreciation. Rent is other expenses. You have to add the outstanding rent. Sundry expenses, other expenses. Balance of P&L will go to reserves and surplus. You will add the profit, transfer to general reserve, all that you will do. Share capital is share capital only. Interim dividend, subtract from reserves and surplus. Debtors and creditors. Debtors will go to, do we have to create a provision? Make a provision of 5% on debtors, right? Okay. Debtors will go to trade receivable, and creditors will go to trade payable. Plant and machinery, property, plant and equipment. General reserve will go to reserves and surplus. This is cash and cash equivalent. Bills receivable and bills payable. Bills receivable will go to trade receivable. This will go to trade payable. Now, what you have to remember is debtors is 52,400. Anywhere in the question we didn't have any bad debts. So directly 52,400 into 5%. 52,400 into 5%. So 52,400 into 5%. 2620 reduce from property plant and reduce from trade receivable, and also show it as other expense in the P&L. Done. Okay, with that we are done with December 23. Let's go into the next one, June 2024. June 24. Yeah, let's go into the next question. Okay, this is from your June 2024 set 1. Okay, now here again, see the frequency of regularity of questions. Again, closing stock is more than opening stock by 3,20,000. So whatever adjustments have repeated, I am not going to discuss that again. Provide for doubtful debts at 4%. Make provision for income tax. I am not discussing this. We have discussed like 3-4 times already. Depreciation includes 32,000 and 48,000. So this one, can you see depreciation over here? Yes, 32,000 and 48,000. Refer the previous questions. We have already discussed the adjustment. Transfer to general reserve 10%. So from P&L we are going to subtract, and general reserve we are going to add. Directors proposed dividend, ignore. Bills discounted not yet matured. It will be shown as contingent liability below the balance sheet. Done. Now only thing is this doubtful debts, because you constantly make mistakes in doubtful debts. That's why I'm doing this. Bad debt is there 24,000. Provision for doubtful debt is how much? 12,000. So what we are going to do, PDD, okay, 24 PDD, we have right now 12,000 minus bad debt 12,000. So PDD becomes 0. And bad debt, what will happen? 24,000. In that 12,000 only got adjusted. So therefore 12,000 balance bad debt 12,000 will go to other expenses. Now debtors, just check our debtors, 5 lakhs. On that, how much they told you to create provision? 5 lakh into 4%. So 5 lakh into 4%, that means 20,000. 20,000 P&L will show it as other expenses because the existing PDD became fully 0, and from trade receivable minus. That's it. Other than that, everything is regular only. Buildings, property, plant and equipment, machinery, property, plant and equipment, closing stock already in the trial balance. That means directly it will go to balance sheet as inventory. No changes in inventory. Loose tools, property, plant and equipment. See, purchase is already adjusted. Purchase of stock in trade. Salaries is employee benefit expense. Directors fees, other expense. Rent, other expense. Depreciation and amortization. We discussed. Bad debt, we know it is going to be reduced from the trade receivable. Investment is non-current investment. Interest accrued on investment will show as other current asset. Debenture interest is finance cost. Advance tax is other current asset. Sundry expense, other expenses. Debtors, trade receivable, bank, cash and cash equivalent. Now sales, revenue from operations. Outstanding expense will be shown as other current liability. Provision for doubtful debt already discussed. Equity, share capital. Share capital, general reserve is reserves and surplus. P&L is also reserves and surplus. Creditors will go to trade payable. Provision for depreciation. What will you do? Minus from PPE. Directly minus from PPE in the balance sheet. 14% debentures. This is going to be long-term borrowings. Once you just check 8 lakh into 14%, how much is it? 1,12,000. Can you see debenture interest here? Yes. Interest accrued but not due, other current liability. Interest on investment, other income. Unclaimed dividend is other current liability. Similar kind of questions. So the nth time they have asked us. Let's go into the next one. This is our December 2024 set 1. Okay. Going into the adjustments. Authorized capital in the share capital note. Just show it. Stock on 31st March 2024 was 35,000. Go and check what we have. Opening stock 30,000. That means 30,000 minus 35,000 is equal to 5,000 negative. This will be shown as changes in inventory. This will be shown as changes in inventory. Okay, then what we are going to do? 35,000 closing stock will go to balance sheet as inventory. Now depreciate plant and machinery and revalue the loose tools at 4,400. Now how much is the loose tools? Loose. Where are you? Loose tools. Yes, 6,000. So now what will happen? 6,000 minus 4,400 is equal to 1,600 will go to depreciation and amortization. And 4,400 will be shown as the new value in the property, plant and equipment. Depreciation on plant and machinery we know. We'll show it as depreciation and amortization and reduce it from property, plant and equipment. Provide 2% as bad debt reserve and 2.5% for discount on debtors. Final dividend was proposed, so ignore. Yeah. Now we'll go further into the question. Okay. Rent, rates and taxes, other expense. Purchases, purchase of stock in trade, then wages, other expense, employee benefit expense, discount. Okay, it's all debit balance. So discount will go to other expense, fuel, other expense, building, property, plant and equipment, carriage inward. You'll show it as other expense or add it to purchase of stock in trade. You can also add it to purchase of stock in trade. Next, sundry debtors, trade receivable. Now, do we have any provision for doubtful debt? No. On sundry debtors, what will happen now? 20,000. Okay. Provision for doubtful debts at the rate of what percentage? 2%. At the rate of 2%. So 20,000 into 2%, 400. This becomes 19,600. And provision for discount. Provision for discount on debtors. This is at the rate of 2.5%. 2.5%. 19,600 into 2.5%. It is 490. 19,600 minus 490. 19,110. This will be our trade receivable. And this as well as this, both of these will go to other expenses in P&L. Next, goodwill, intangible asset. Plant and machinery, property, plant, equipment, loose tools, property, plant, equipment, which we already discussed, is going to be reevaluated at a different figure. Advertisement, other expenses, general expense, other expenses, bad debt, other expenses. Okay, there is no provision for bad debt. So directly you put it to other expense. Can you see there is no provision for bad debt here? So directly other expense. Debenture interest, half year interest up to 39. So what we do? 625 plus 625. Other half also we are going to add. This is going to be 1250, which will be shown as finance cost. And this 625 will go to other current liabilities. Miscellaneous expense, other expense, insurance, other expense, cash and bank, cash and cash equivalent. Credit balance, equity share capital will be share capital. Debentures will be long-term borrowings. And sales, revenue from operations. Sundry creditors is trade payable. Sundry creditor will be trade payable. Bank OD. Okay. You can show it as short-term borrowings, discount, other income because it is discount received, and transfer fees, other income, returns outward. Returns outward will what will you do? Purchase returns, right? So minus from purchase of stock in trade. This is what you're going to do. This is your December 2024 set 1. Now we'll go to December 2024 set 2. December 2024 set 2. Closing stock is 1,76,000. Go and check what is the opening stock. 1,50,000. So 1,50,000 minus 1,76,000. That means there is a negative of 26,000. What you are going to do with this negative? This negative you are going to show it as changes in inventory, and 1,76,000 you will show it in the balance sheet as inventory. For the nth time we are having this. Make provision for income tax. What will you do? PBT, whatever PBT you get, calculate 40% of that and then show it as short-term provisions. Depreciate plant and machinery, all this patents 5% we have seen. Outstanding rent and outstanding salary. Directors recommend dividend and transfer. Trade receivable 5,000 are due for more than 6 months. Okay. Provide 1,020 on doubtful debts. If 5,000 is more than 6 months, how much is the trade receivable? Yes, 5,000 is greater than 6 months. That means 60,000 will be less than 6 months. You're just going to present it in trade receivable, and they have told 1020 provide for doubtful debts. So trade receivable minus, and you're going to show it as other expenses. Authorized capital and all, you're just going to show it over there. 2,000 issued capital also is given, and they have told, however, issued for consideration. 2,000 shares are issued for consideration other than cash. So in the share capital note, you are going to present it separately. Clear? That's it. Done. We don't have anything else. Okay. Purchases, purchase of stock in trade, salaries, employee benefit expense, outstanding rent and all. We have to add outstanding salary and all. Carriage and freight and carriage, what you're going to do, either you add it to purchase of stock in trade or you show it as other expense. Furniture, property, plant, equipment, contribution to PF, employee benefit expense, rent, rates and taxes, other expense. Remember about the outstanding. Stationaries, other expense. Repairs, other expense. Insurance, other expense. Miscellaneous, other expense. Staff welfare expenses, employee benefit expense, plant and machineries, property, plant, equipment, cash and cash equivalent for cash at bank. Patent is intangible asset. But remember, they have asked you to amortize, depreciate the patent also. Trade receivable is trade receivable only. Then purchase returns, you are going to subtract from purchases. Sales will be revenue from operations. Discount received, other income. Balance of P&L, it is P&L, reserves and surplus. Share capital is share capital. Trade payable is trade payable. General reserve is reserves and surplus. This is how it should be, guys. Done. 6. This is our June 2025. Let's have a look at June 2025 examination question. Sorry, not examination, model test paper question. Third one. Okay. Following information extracted. Let's go and see. Prepare P&L and balance sheet as per schedule 3. Stock on 31st March 2024 valued at lower of cost or NRV was estimated to be 2 lakhs. Closing stock is 2 lakhs. Okay, now go and check in the trial balance. We have opening stock 1,40,000. So 140 minus 200 will be 60 negative. This will be our changes in inventory, and 200 will be our inventory in the balance sheet. Okay, done. Fixtures, fittings, tools, equipment, all related to administration. Okay, depreciation is charged at the rate of 20% per annum on cost. Full year's depreciation is charged in the year of acquisition, but no depreciation is charged in the year of disposal. Okay, that is bakwas. We cannot do that as per AS 10. Okay, so 20% will be the depreciation. 20% what will you do? You will show it as depreciation and amortization. And from PPE, do we have provision for depreciation? Depreciation provision, see. You will add it to depreciation provision. Add it to provision for depreciation, and the total provision for depreciation will be subtracted from property, plant and equipment. During the year, the company purchased equipment of 1,20,000. It also sold some fittings which had originally cost 60,000 for 10,000, for which the depreciation of 30,000 had been set aside. Okay. The average income tax of the company is 50%. Factory closure cost is to be presumed as an allowable expenditure as per income tax purpose. 50% is our average income tax rate. So whatever PBT we get, 50%. Company proposes to pay dividend, proposes profit transfer to reserve. So from P&L you will subtract, and from to general reserve you will add it. Now let's hope they have done the calculation for assets. For a change, they have given all the notes. Perfectly as per schedule 3 they have done this time. Perfectly as per schedule 3. Can you see 540 they got profit, 50% is tax. See, no dividend, nothing. Because dividend is not supposed to be shown unless it is paid. Transfer to general reserve, that's it. Can you see? Proposed dividend shown as contingent liability outside the balance sheet. It's not going to be there. Unless dividend is paid, we cannot show dividend at all. Yes, that should be it, guys. Yeah, that should be it. It's an easy question. So these things you have to be careful. Okay, purchase equipment for 120, doesn't matter. Sold, doesn't matter. Okay, so what you're going to do over here, administrative expenses is other expense, cash and cash equivalent, cash received on sale of fittings. Cash received on sale of fittings 10. What will you do? Add it to cash and cash equivalent. Following information it is. This is not balances. So 10 will be added to cash and cash equivalent, and then sale of fittings you have to see the profit. Fittings originally cost 60. So 60 will be reduced from the cost of the fittings for 10,000, okay, on which depreciation was 30,000. 30,000 is going to be subtracted from provision for depreciation minus 60 minus 30, 30 sold for 10,000. That means 20,000 is loss on sale. It will go to other expense in the P&L. That's it. That's all we have to worry about. Long-term loan, long-term borrowing, investment, non-current investment, depreciation we already discussed. What has to be minus we discussed down below there. Distribution cost, other expense. Factory closure cost, other expense. Fixtures, fittings, tools and equipment cost. Something has to be subtracted from this cost. Remember down the sale one. Profit and loss balance, opening balance. This will go to reserves and surplus. Purchase of equipment 120 will get added to the fittings. This we have to add. Then purchase of goods for resale. That means purchase of stock in trade. Sales, this will be your revenue from operations. Share capital. Okay, then we have trade creditors, which is trade payable, trade debtors, which is trade receivable. That's it. A simple question, but in a little different manner they have asked it. Next, we'll go into set 2 of June 2025. June 2025 set 2. 1,500 equity shares were issued for consideration other than cash. In your share capital note, give the info. Loan for 1,20,000 from IDB is inclusive of 6,000 interest accrued but not due. Loan is hypothecation of, okay, now what will you do? 1,20,000 in this interest is also included. Remove the 6,000 and show it as other current liability and show 1,14,000 as long-term borrowing. Debtors of 50,000 are due for more than 6 months. So go and check how much is the debtor. See, prepare only balance sheet they said. Okay, go and check how much is the debtor. Debtor is debtor 1,60,000. So what will you do now? 50,000 is due for, okay, 50,000 is due for more than 6 months. That means 1,10,000 is due for less than 6 months. You just have to present it that way. Cost of the assets are there. Cost. Okay, property, plant and equipment. You will show the cost, you will show the depreciation, you will get the net value. Bank balance includes 2,000 with trust bank, which is not a scheduled bank. How much is the cash at bank? 1,97,600. So 2,000 is non-scheduled bank. That means 1,95,600 is scheduled bank. Okay, disclose it accordingly in your cash and cash equivalent note. Bills receivable 22,000 maturing on 30th June have been discounted. This is going to be contingent liability. Contingent liability. The company had contract for erection of machinery at 1,50,000, which is incomplete. This is also going to be contingent liability. You are going to show it below. Done. That's it. These are the adjustments. In fact, there is no adjustment only. Everything that they have told is only for presentation purpose. Now, equity share capital, calls in arrears minus from share capital, land, property, plant and equipment, building, property, plant and equipment, plant and machinery, property, plant and equipment, furniture, property, plant and equipment, general reserve, reserves and surplus, loan from IDBI. Loan from IDBI we have already discussed, refer the note. Okay, loan will go into long-term borrowing, but not 1,20,000. Loans unsecured, this is also long-term borrowing. Provision for taxation, short-term provisions. Advances debit, that means short-term loans and advances. It's an asset. Proposed dividend, other current liability. Profit and loss account, reserves and surplus. Cash balance, cash and cash equivalent. Cash at bank, cash and cash equivalent. Preliminary expense, other expenses. Sundry creditors for goods and expenses. Sundry creditors. What will you do now? Trade payable, stock. This is the closing stock. This will go to inventories. This much we have to understand. Only balance sheet is asked. That should be it with this particular one. Let's go to 8. If you just discuss all this also, no, you'll be able to score the marks in the exam, guys. Yes. Because so many things are repeated again and again. What did they ask here? Prepare P&L and balance sheet. Now depreciate plant by 10%. Okay. Property, plant and equipment minus. Show it as depreciation and amortization in P&L. Half year's debenture interest is due. So go and check what is the debenture. 30 lakh. 30 lakh into 12% divided by 2. 1,80,000. So debenture interest paid. I think similar question we had. So 1,80,000 is other current liability. This 180 plus 180, totally 3,60,000 will be shown as finance cost in the P&L. Create 5% provision for doubtful debts. Okay, bad debt provision we already have. Now what will you do? 21,000 will be adjusted with 35,000. So only 14,000 provision will be remaining. Okay, debtors are how much? Debtors are 8,70,000. 8,70,000 into 5%. 8,70,000 into 5%, 43,500. Out of that already 14,000 we have. 29,500. I think we had the same question. Same question we already discussed, guys. Stock, closing stock, no final dividend. Yes, I'm not discussing this question because very recently we saw this question. December 2025 set 1 done. December 2025 set 2 now. Let's hope something different they have given. See, closing stock as on 31st March was 2,12,500. You know, opening stock minus closing stock you do and put the difference into changes in inventory. Closing stock, take it to the balance sheet. Depreciation rates are given. Outstanding salary. Trade receivable includes 25,000 from Mr. Reddy and trade payable includes 15,000 due from him. So what will you do? Common item is how much? 15,000. In this 15,000 you are going to subtract from trade receivable also, and 15,000 you are going to subtract from trade payable also. Create a provision for doubtful debts on trade receivable. Provide for income tax. What will you do? Minus from profit before tax and show it as short-term provisions. Now this create a provision for doubtful debts 5% on trade receivable. Trade receivable is 12 lakhs. So out of 12 lakhs, trade receivable, 12 lakhs minus, remove the 15,000. Okay, remove the 15,000, you get 11,85,000 of trade receivable. Now what is going to happen is create a provision of 5%. Okay, is there already a provision? You have to go and check, is there a provision? No provision. No existing provision is there. Into 5%. 11,85,000 into 5% makes it 59,250. 59,250 is your provision. 59,250. What will you do? Show it as other expense and also subtract from trade receivable in the balance sheet. Other than that, I don't think there should be any problem. This is share capital. This is long-term borrowing. Furniture is property, plant and equipment. You know what to do with depreciation, machinery, building, all are property, plant and equipment. Non-current investment is non-current investment. Okay, sales and sales return you are going to set off, and this is going to be revenue from operations. Interest received on investment, other income. Okay, and interest on bank loan is finance cost. Then you have purchase and purchase returns. You can set off purchase and purchase return. It's going to be purchase of stock in trade. Opening stock. Opening stock, what you're going to do? You're going to adjust it with the closing stock. You know the closing stock here, 2,12,500. Changes in inventory, discount, other expenses, carriage on goods sold, other expenses, or you can also add it to the purchase of stock in trade. Then you have trade payable, advertisement, other expenses, bad debt. We already discussed. Oh, there is no provision, existing provision. So bad debt will go to other expenses. Salary is employee benefit expense. Audit fees, other expense. Contribution to PF is employee benefit expense. And finally, cash and cash equivalent is here. Done, guys. Okay, easy 14 marks. Please do not miss out on this in the exam. Next, I am going into cash flow statement. Let's go into the next chapter, guys. This is cash flow statement. Okay, regularly asked for 7 marks and also in MCQs. So cash flow statement is a statement showing inflow and outflow of cash and cash equivalent. What is cash and cash equivalent? Cash at bank and deposit. Now, which deposit? Short term, highly liquid. Okay, short term, highly liquid deposits. That is investments. Short term here is 3 months, which can be easily converted into cash. Okay, cash flow statement, you have 3 categories. That is cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. Now, what is operating activities? This is basically your day-to-day activities. Activities related to your day-to-day business is operating activity. Investing activities, activities that are related to purchase and sale. Activities that are related to purchase and sale of your non-current assets. Anything related to your purchase and sale of your non-current asset is considered as investing activity. Clear? And related to your financing activity. Financing activity is your non-current liabilities. Non-current liabilities. Now see, let's say some example. Purchase and sale of goods, day-to-day operating activity. Salary, day-to-day operating activity. Rent, income tax and all day-to-day expenses, operating activity. Now when we go to investing, purchase of land, you don't do it day-to-day. It's investing activity. Sale of land, purchase of investment, sale of investment, interest received on investment, all this is investing activity. Now, issue of shares. If you issue shares, it is financing activity, buyback of shares, financing activity, redemption of shares, financing activity, issue of debentures, financing activity, dividend paid, interest paid, everything financing activity. So your non-current liabilities, non-current assets are usually taken care of by financing and investing activities. Interest and dividend, understand this. If it is paid by any company pays interest, it is cash flow from financing activity. But if it is received by banking or investment companies, okay, received, okay, and then it's going to be cash flow from operating activity, because banking company, their main business is giving loans. So when they receive interest, it is operating activity. And investment companies, their main business is to make investments, and when they receive it, it is called as operating activity. Received by other companies, it's always investing activity. Taxes on income. Tax on operating activity is cash flow from operating activity, income tax. Tax on investing activity. That means when we have tax on sale of land or something, it is investing activity. Now, cash flow from operating activity, we have 2 methods. That is direct method and indirect method. Okay, direct method is simple. Information is straightforward given to you. You have to use that information. Cash sales. Okay, cash sales. Amount received from debtors. Credit sale is not there. Amount received from debtors. Amount received from debtors. Clear? Now, cash sale plus credit sale is equal to total sale. We don't want total sale. We want only cash sale, because only cash sale generates cash for us. Okay, credit sale doesn't generate cash for us. So what we are going to do is, credit sale, we have to see how much money we have received. So amount received from debtors is basically opening balance of debtors plus credit sale minus bad debt, no money, minus sales return, no money, minus discount, no money. Okay, then you subtract the closing balance of debtors. If you get a difference, that is the amount received from debtors. Follows this methodology, you will get the amount received from debtors. Cash purchases, again you have to pay money, cash outflow. Amount paid to creditors, opening balance of creditors plus credit purchases minus purchase return, no need to pay money, minus discount received, no need to pay money. The minus closing balance of creditors, you'll get amount paid to creditors. Amount paid to creditors will be taken over here. Other expenses paid, you minus. That time you will get the cash flow from operating activity before tax. Then you subtract the tax paid, you will get cash flow from operating activity. Clear, guys? Yes. Indirect method is ulta. That means you're going to do reverse calculation here. Net profit, that is profit after tax. If you're starting with profit after tax, if you're starting with PBT. Now, let's have a quick look. Okay. Yeah. Net profit, profit after tax. You can start with PBT also. You can start with retained earnings also. Imagine you start with profit after tax. All the non-cash items which are already there in P&L and the items which are there in P&L which are covered under other heads, that you have to plus or minus. Now, if they are debited or credited to P&L. Now, depreciation amortization is a non-cash expense that is already subtracted from P&L. You add it back. Interest paid is a cash item only, but it is not operating activity, so you remove it, add it back, and you subtract it in cash flow from financing activity. Interest received, you got the money, but it's not operating activity, remove it, and you add it to cash flow from investing activity. Profit on sale of asset and loss on sale of asset, both are not operating activity. Profit is added to the profits, so remove it. Loss is removed from profit, so you add it back. So you are doing reverse working, so you will reach cash flow from operating activity before working capital changes. Now, working capital changes simple. Current asset increases, subtract. Current asset decreases, add. Current liability increases, add. Current liability decreases, subtract. I'll take one example and I will discuss this. Current asset, I'm taking the example of debtor. Okay, if debtor increases, that means we have made credit sale. Credit sale doesn't give us money, so subtract. Debtor decreases, that means debtor has paid the money, add. Money comes in. If I take creditor, creditor increases, that means we have made credit purchase, add back. Purchase is expense, add it back. Creditor decreases, that means we have received the money, we have paid the money, so subtract. That time you'll get cash flow from operating activity after working capital changes, tax paid, whatever is there minus, you'll get the cash flow from operating activity. Okay, cash flow statement format looks like this. Operating activity, investing activity, financing activity, plus or minus will be there. Net cash flow you will get, plus opening balance of cash and cash equivalents, you will get closing balance of cash and cash equivalents. Note, make ledger of assets if required to find. You have to prepare ledgers whenever you need to find asset purchased or asset sale or depreciation or profit or loss on sale. If at all you require that, you will have to prepare a ledger and see the balancing figure. That should be it with the cash flow statement discussion. Now let's go into the questions of cash flow statement. Let's see in December 2023 if there is any question on cash flow statement. Yes, CFS, they've asked 7 marks question. Calculate cash flow from operating activity using the following. 7 marks. Let's hope they have solved this. Wow, look at this. Direct answer, 10,30,000. ICMA laziness. Yes. Net profit before tax. Net profit before tax, that means we are starting with PBT. Okay. Items considered in determining the above profit. Interest on long-term borrowings. Interest on long-term borrowing is a financing activity, so you will add this back. Depreciation and amortization is a non-cash item, so you will add it back. Transfer to reserves. Okay, transfer to reserve is done. Items considered in determining the above net profit. Transfer to reserve is a non-cash item. You have transferred to reserve, so that also you add it back. Gain on sale of machinery is an investing activity, so you are going to subtract it. Okay, that time you will get cash flow from operating activity before working capital changes. 6,80,000 plus 80 plus 170 plus 1 lakh minus 60,000. You will get 9,70,000. Okay, let's look at the working capital changes. Trade receivable, okay, has decreased. So 550 minus 480. Trade receivable decreased, so you have to add it back. Trade payable increased, so 20,000 you are going to add it back. Okay, so current assets, whatever direction it moves, you do the opposite. Current liability, whatever direction it moves, you do the same thing. So inventory has increased, so 40,000 will be subtracted. Prepaid expense has increased, so 10,000 will be subtracted. Income received in advance. Income received in advance has increased, so 20,000 will be liability increase added. So 970 plus 70 plus 20 minus 40 minus 10 plus 20, 10,30,000. Can you see 10,30,000 over here? 10,30,000 is your value. Okay, cash flow statement. This is the situation. December 2023. Next, we'll go into June 2024 and see if there is a cash flow statement question. Yes, there is a cash flow statement question here. 5. Okay, this time they have solved and given us information. So now, from the following summary of cash account of Excel Pharma for the year ended 31st March 2024, calculate cash flow from operating activity using direct method and prepare cash flow statement. So basically, full cash flow statement we have to prepare. Now, understand this. We start with this cash sales. Cash sales is operating activity. Can you see in operating activity 3 lakhs? Cash flow from operating activity, cash flow from investing activity, cash flow from financing activity. Now, trade receivable means what? We got money from our debtors. That is also operating activity. So 3,20,000 operating activity. Next, 4,000 interest and dividend. Interest and dividend received is investing activity. So go to investing activity. You can see 4,000 over here. Next, bank loan. Bank loan means what? Bank loan. We borrowed money. So it will go to financing activity as positive 3 lakhs. Next, sale of investment. If you sell investment, you'll get money, but that is investing activity. 1,60,000 investing activity. Next, trade commission. Trade commission means related to your day-to-day activity. Operating activity 80,000. Next, cash purchase and amount paid to trade payable. All these are operating activities. See cash purchase, trade payable, then rent and administrative expense. All these are minus. This is cash outflow. Okay, then you can see tax paid, income tax, that is also outflow. So that is all cash flow from operating activity. Now, investment. By investment means what? Investment purchased. Investment purchase is investing activity. So 1,80,000 you can see over here. Then repayment of loan is financing activity. So 2 lakh. Can you see bank loan repaid is there over here? Next, 14,000 interest on bank loan is also financing activity. You can see it in financing activity. This is just the closing balance. Now, if you see cash flow from operating activity is negative, investing activity is negative, financing activity is positive. Take the opening balance 2,50,000, add it over here. So net cash flow, we got 12,000 net cash flow. 2,62,000 will be the closing balance. This is it for 7 marks. Operating, investing, financing, net it up, and that time you'll get the net cash flow. Add opening balance, you'll get the closing balance. Done. June should also be done with that. Now, we go further. We go further into CFS 5B. Again, they have asked for 7 marks. Okay. The following figures have been extracted from the books for the year ended. You are required to work out cash flow from operating activity. Only cash flow from operating activity. Net profit before taking into account income tax and after taking into account the following items was 10 lakhs. Net profit before income tax, but after the following items which they have given A, B, C, D, E. So net profit is how much? 10 lakhs. Clear? Depreciation on fixed asset is a non-cash item. Add back 2,95,000. Discount on issue of debenture written off is a non-cash item. Add back 15,000. Interest on debentures paid is a cash item, but it is other head item. Add back 1,75,000. Book value of investments 1,50,000. Sale value of investments 1,60,000. That means there is 10,000 of profit on sale. Profit on sale is added to P&L, so you subtract from P&L. 10,000 minus. Interest received on investment. Interest received on investment is investing activity. So 30,000 minus. You will get cash flow from operating activity before working capital changes. Then what you are going to do? Income tax paid. That is the last item. 5,25,000 minus last. Then you have non-cash working capital. 5,86,000 on 1/4 and 6,39,000 on 31st of March. That means working capital has increased. Okay, so you can see 639 minus 586, you're getting 53,000 increase. That means cash outflow minus 53,000 minus. Done. You'll get your cash flow from operating activity. Easy 7 mark question they have asked. Okay, guys, that should be it. That should be it. Now you're going into the next one. Yes, next exam also in June 2025 also they asked one cash flow question. That means every question, every exam, 4 out of 4 they have asked cash flow question. Okay, this should be your question now. Yeah, we'll see whether they have solved so that we can discuss directly. Yeah, they have solved cash flow statement. Let's see. The following information has been provided by Apex Limited for the year ended. You are required to prepare cash flow statement only full. Sales for the year 48 lakhs, entirely made in cash. Entire cash, so that means 48 lakhs you will take it as cash sales. Can you see 48 lakhs cash sales? Next, all purchases were on credit. All purchases on credit. Cost of goods sold was 75% of sales. One second, guys. Yeah. Cost of goods sold was 75% of sales. So COGS is 48 lakhs into 75%. That is 36 lakhs is cost of goods sold. Now, how do you get cost of goods sold? Cost of goods sold is basically opening stock plus purchases plus direct expenses minus closing stock. Now, opening stock we don't know. Closing inventory was higher than opening inventory by 50,000. So what we will do, opening stock if I take 0, purchases I don't know yet. Okay. I have to find purchases only, no? Cost of goods sold, I know 36 lakhs. Opening stock plus purchases plus direct expense we'll see. Operating expense is 3,60,000. So plus 3,60,000 minus closing stock, which is already given. Okay, 50,000 more they said. So 50,000. Okay, so now what will you get? You will get 36 lakhs minus 3,60,000 plus 50,000. 32 lakh 90,000 is your purchase, but this is credit purchase. Now trade payable was 1 lakh more than the balance on end of the year was 1 lakh more. So if I prepare a small trade payable account over here, trade payable, if I take by balance brought down as 0 and to balance carried down 1 lakh, closing balance is 1 lakh. Purchase is what? 32 lakh 90,000. So 31 lakh 90,000. 1 second. Trade payable closing balance was more, no? Yes. And opening stock closing inventory was higher than opening inventory. So closing inventory is 50,000. If I take that, 31 lakh 90,000. Okay. You should actually get purchase of 31 lakh 90,000. 31 lakh 90,000, not purchases, amount paid to creditors. Now what they have done here, payment to supplier, 31 lakh 90 which we took and the 3 lakh 60 operating expense which we took. So both together 31 lakh 90 and 3 lakh 60, they have taken it as 35 lakh 50,000 payment minus. Clear? So directly they have taken that amount. Next, what I mean, together they have taken, we would have taken it separately, amount paid to creditors and operating expense separately we would have taken. Okay. Next, you have closing inventory done, operating expense done, tax paid, 1,50,000. 1,50,000 income tax paid. I think they have given double effect of 3,60,000. Can you see? Again, operating expense is there over here. Let's see, they have shown the calculation also. 75% is purchases. See, here they have not taken the operating expense. Operating expense should be taken actually. So that's why you're getting the double impact. No problem. You can do the same way. No issues. You'll get still same answer only. Okay. Income tax paid is 1,50,000. Next, you can go and check. Taxes paid. The company paid interest of 1,20,000. Interest means it is financing activity. 1,20,000. Then company acquired a building for 4 lakh and bought a new furniture for 2 lakh during the same year. 4 lakh, 2 lakh, both will be investing activity. Dividend received is also investing activity, 10,000. Next, opening balance, closing balance, 40,000 is opening balance, 70,000 is your closing balance. Yes, net cash flow is coming up to 30,000. That should be it. It's a simple question. Okay, just be careful with the purchases calculation. Now, December 2023 mock test paper. We'll have a look at the mock test paper and we'll see if there is any cash flow. No, they haven't asked anything from cash flow here, only standards they have asked. Yes. So we'll see December 2023 model test paper 2. In that, again, we have banking standards CFS. There is a CFS question here, which they've asked for 7 marks. Prepare cash flow from operations. Amount of cash flow from operations. Only operating activity they have asked. Now, see over here. We start with net income. Income tax deferred. Okay, 14,050. We can start with 14,050. Oh, they are following direct method. Looks like direct method is simpler. Cash flow from operation. We could have done indirect method also. Did they tell anywhere direct method only? No. Okay, they have done direct method. So I'll explain direct method to you. 70% of gross revenue from sales were on credit. 70% of gross revenue is on credit. So 1,62,700 into 30%. This is cash. Now collection from debtors. Collection from debtors. Okay, what you're going to do is sales 1,62,700 into 70%. 162,700 into 70% is 1,13,890. This is credit sales. Okay. Now here they have given changes in current asset and current liability. Accounts receivable has gone down. Trade receivable has gone down. So see the calculation here. This is our credit sales. There is a bad debt. How do we know there is a bad debt? Here only in the question they have written 2050 is bad debt. 2050. But there is allowance for bad debt of 1,900. That means 2050 minus 1,900. 150 is the net bad debt. 150. Okay, that bad debt, what will happen? See, less bad debt 150. So now this is the situation of your trade receivable. Now add decrease in trade receivable. If it is decreasing, you have to add back 7,150. So collection from your debtors is 120,890. You can actually prepare a trade receivable ledger like how you do in accounting from incomplete records, and also you can calculate. So 120,890 is taken over here. Clear? Now we go into one by one items. Merchandise purchase amounted to 92,000 were on credit. Okay. Equity on ABC's earnings. This is dividend income. Ignore it. Cost of goods sold is there 89,300. Salary payable total to 1,600 at the end of the year. Amortization premium on bonds. Ignore. No dividend were received from other companies. Okay. XYZ Limited declared cash dividend. Cash dividend will go to financing activity. We don't have to worry. Now merchandise purchase only is what we are supposed to worry about. Now see the next one. Payment to supplier 86,350. How are you getting this 86,350? Payment to supplier. Cost of goods sold we know. Add increase in inventory. If there is increase in inventory, what has happened? That means more goods have been purchased. Increase in inventory. You got the total purchases. Out of total purchases, increase in trade payable. Trade payable increased. So that means we have not paid that amount. Only the differential amount we have paid. The balance amount we have paid. This will be payment to supplier 86,000. Okay, 86,350. Next, salary. Now see what they have done for salary. You have to be a little careful. Okay, salary expenses 34,400. This is there in the P&L. Okay, decrease in salary payable. Decrease in salary payable. What is this decrease in salary payable? Outstanding salary has gone down. That means you have paid that salary. When you add this, you will get your salary paid. Salary paid will be shown 36,450. Okay, payment for insurance. Now insurance, you see, insurance is shown as 500. Increase in prepaid insurance. That means you have more prepaid insurance. You have paid. So 1,200 you are going to subtract. Next you have interest expense. 1,350 they said amortization. Interest payment is 12,000. Okay, interest payment is 12,000. Wait, what is the interest amount here? Payment of insurance, interest payment 12,000. Actually, it shouldn't have been in operations only. It is going to be shown as Financing activity, but they have put it over here. This is wrong. Interest shouldn't have been there. Research and development and all directly you're taking. Income tax payment directly you're taking 6,600. That should be it. Okay. Research and development. Okay. Patent amortization is not going to be taken. Okay. Income tax, current tax is there 6,600. Directly you're subtracting. So only mistake that they have done is interest shouldn't have been there. Interest shouldn't have been there. It's a financing activity. When you're following direct method, you can't put it over here. Yes. That should be it with that one. Let's go into the June 2024 set 1. We'll see if there is a cash flow question. Banking, insurance, standards. There is no cash flow there. December 2024, we'll see set 2. Banking, insurance, standards. There is a cash flow statement question. Yes, comparative balance sheets of the company is given below. Now they are telling you are required to prepare cash flow statement indirect method. Yeah. Now you can see over here 23, 24, 23, 24. 2 years comparative balance sheets are given and they're asking us to prepare cash flow statement. Cash flow statement as per AS3 indirect method. So now what we do? We directly go into dividend paid amounted to 1750. Okay. Land was purchased for 5,000 and amount provided for amortization of goodwill amounted to 2,500. Debentures were repaid to the extent of 4,000. Now, one by one, share capital has become from 35,000, it has become 52,000. That means 17,000 is share issued. Go straight and write. Okay, land account, goodwill account, all that you forget. Directly see shares issued 17,000. Next, debentures from 7,000 it became 3,000. They only told that debentures were repaid to the extent of 4,000. Debenture repaid is financing activity. Can you see 4,000 in financing activity? Outflow minus. Next, after that, you have creditors. Creditors from 5180 it became 5920. So 5920 minus 5180, increase in creditors is added back in working capital changes. 740 add back. 740 increase in creditors. Clear? Next, provision for doubtful debts. 350 became 400. 50 provision. Increase in provision. Provision is a liability. Add back. Next, you have profit and loss account. 5020 became 5280. So 5280 minus 5020. 260 is your retained earnings. You can start with retained earnings as your starting point. 260 net profit. Okay. Next, after that, you go into the asset side. Can you see this is opening balance? This is closing balance. At the end, you will find it. 5,500 is opening balance. 18,900 is closing balance. Okay. Next, you go into book debts. Book debts means debtors. Book debts means debtors. 7450 became 8850. That means 1,400 increase in debtors. That means decrease in cash. You can see in working capital changes. Increase in book less. See, can you see they have written less and subtracted that 1,400. Then you have the next thing, stock. Stock has gone down. 24,600 minus 21,350. 3,250 decrease in stock. 3,250 decrease in stock. You are going to add it over here. Decrease in stock. Clear? Next. Land has gone from 10,000 to 15,000. They said land was purchased for 5,000. So 5,000 land purchase. What will you do? You will show it in investing activity. 5,000 purchase of land, investing activity. After that, you have only one item here. Goodwill from 5,000, it has become 2,500. They only told it is amortized. Amortization of goodwill, we have to add it back in non-cash items. So 2,500 is going to be added back. Now, dividend paid is there. Outside the trial balance, they have given dividend paid. Outside the balance sheet, dividend paid. Okay, added back over here because it is not operating activity, and show 1,750 over here, financing activity. Can you see? Every single item is discussed, whatever is there. When you do your plus and minus, you'll get the every single activity's answer, and then you'll get the net cash flow also. That is done with December 2024. Now, December 2024, there is a set 2. In set 2, we will see if there is a cash flow statement question. Yes, there is one cash flow statement question here. Prepare cash flow statement. Again, last year, this year, they have given us information. Next one, students. We'll see company sold one fixed asset at 1 lakh and the cost of which was 2 lakh and the depreciation provided on it was 80,000. Okay. The company also decided to write off another fixed asset costing 56,000 on which depreciation amounted to 40,000 had been provided. Okay. Depreciation fixed asset provided 3,60,000. Okay. These three are related to one thing. Company sold some investment at a profit of 40,000 which was credited to capital reserve. Okay. So it's not going to bother us. Debenture and preference share capital were redeemed at 5% premium. Fine. Company decided to value stock at cost, whereas previously the practice was to value cost less 10%. The stock according to the books on 31st March was 2,16,000. Stock on 31st March 2024 was correctly valued at 3 lakhs. So this is not correctly valued. So this will become 2,16,000 is 90%. 2,16,000 is 90%. How much is 100%? So this becomes 2,40,000. This becomes 2,40,000. So what will you do now when you go and check? Yeah, see, 2,40,000. So opening stock will be increased by 24,000. Have they shown the added it? No. Opening stock will increase by, so opening balance of P&L will be increased by 24,000. Okay. Therefore, the revised figure of current asset also we have to take. Okay. Now 24,000 increased. Directly they have added. Now see over here. P&L. Okay. 2,80,000. Now when we add the 24,000, opening stock increase. See, 1 second. 280 minus 4,04,000. You have 124. 124 is the difference. Increase in opening stock will decrease the profit. So remove that 24,000. So now your profit is only 1 lakh. Can you see? That's why the starting point has been given as 1 lakh. Okay. Increase in opening stock decreases in profit. Increase in closing stock increases the profit. Okay. Be careful with this. Now we'll start with share capital. After that, do we have anything else? No. Share capital 12 became 16. That means shares issued 4 lakhs. Can you see shares issued 4 lakhs? You got money. And over here, preference share capital 4 became 2,80,000. That means 120 is the reduction. 120. But they said it was redeemed at a premium of 5%. So 6,000 premium. So total amount that we have paid to preference shareholder is 1,26,000. 1,26,000 you will find over here. 1,26,000. Clear? And 6,000 premium on redemption of preference share. You have to add it back because it would have been taken from P&L. Now after premium on redemption, then can you see capital reserve 0 became 40,000. That is because they sold that investment and put the profit over there. Doesn't matter. See over here. Company decided no, where is that? Company sold some investment, got 40,000, put it to capital reserve. Okay, no problem. It has not affected P&L, so it will not bother us. General reserve 680 became 8 lakhs. 1,20,000 increase. Add that back. Okay, it's a non-cash item. Then P&L 280 became, that we already took. Debentures 4 lakh became 2,80,000. Again, debentures are redeemed for 1,20,000. 6,000 premium, 1,26,000 we are paying to the debenture holders. So 1,26,000 will be shown over here and 6,000 will be added back over here. 6,000 will be added back over here. Clear? Yes. Next, what do we do next? Current liabilities 480 became 536. So 480 minus 536, there is a 56,000 increase in current liability. Working capital changes, you will show 56,000 increase in current liability. Next, you have provision for tax. 360 became 340. Okay, that means tax is paid. Last year's provision would have been paid this year. Let's see what they have done. Tax paid. Can you see last year's provision is income tax paid for this year. And this year's provision 340 we have to add back because it's a non-cash item. Last year's provision, tax paid. This year's provision added back because it's a non-cash item. Now, fixed assets. Fixed assets, you have to be a little careful. 32 became 38. That means we have purchased, right? But out of that, one was sold. So 32 has become 1 lakh minus when we do 31 lakhs. And decided to write off one more asset costing 56,000. So minus 56,000. So 31 lakh minus 56,000 is 30 lakh 44,000. But here it is showing 38 lakhs. So 38 lakhs, 7 lakh 56,000. Where is it? Investing activity. Purchase of purchase of asset 8 lakh 56 it's becoming. Is it 8 lakh 56 guys? Okay, now see over here. 32 lakhs. Correct? We have 32 lakhs. Fixed asset. Company sold one fixed asset for 1 lakh. Oh, the cost of which was 2 lakhs. 2 lakhs. You remove 2 lakhs. Then one more they have written off which was costing 56,000. Remove that 56,000 also. So 32 lakhs minus 2 lakhs minus 56,000. 29 lakh 44,000 should have been the balance. Can you see the balance is showing 38 lakhs. So minus 38 lakhs. Yeah, 8 lakh 56,000 is asset purchased. Asset purchase is cash outflow for us. So 8 lakh 56,000 cash outflow. Sale of fixed assets, they told it was sold for 1 lakh. Directly you take investing activity, 1 lakh add. Then sale of investment, they have not told anything. See, investment over here has gone from 4 lakh to 3 lakh 20. That means 80,000 investment was sold, but it was sold at a profit of 40,000. So sale of investment is 1 lakh 20,000 positive. 80,000 reduction, 40,000 profit, higher value. So 1 lakh 20,000. Now next, if you see over here, there is one depreciation on fixed asset, 3 lakh 60,000. Add back non-cash item, 3 lakh 60,000. Loss on sale of fixed asset. Loss on sale of fixed asset, how you are getting? See, fixed asset of 1 lakh. Okay, 2 lakh was the cost and depreciation provided on that was 80,000. That means 1 lakh 20,000 is the net value of that asset, but it got sold for 1 lakh. So 20,000 loss on sale of asset. Add back. Done. Then over here, 56,000 cost. We wrote it off for 56,000 minus 40,000. 16,000 is the value. 16,000 is the value of that asset. Okay, that got written off. Written off means non-cash again. Add back. Done. See, can you see everything over here? Only thing that is remaining for us to discuss is other current assets. Now, if you see, opening balance is not 1,10,000. Opening balance should be 1,10,000 plus that 24,000 you have to add back. So 1,34,000 will be the opening balance. Sorry, not 1 lakh. 11,34,000 will be the opening balance. So 13,10,000 minus 11,34,000. 1,76,000 inventory increase. If it is increase, cash flow will be decreasing. 1,76,000. So what you have to do is opening stock increases, profit decreases. Change the profit situation over there. And inventory, opening inventory, change it, increase the inventory, and then you see the changes in working capital or difference between opening and closing. Yes, this should be a very nice question to solve. Next, we'll go to the next one. We'll see if there is any cash flow statement question. This time, insurance, standards, no cash flow there. Let's go to the next one. June 2025 set 2. Standards. Again, they have not asked any cash flow. December 2025, we'll see set 1. 4. Yeah, there is a cash flow statement over here. They're telling following is the relevant items of cash flow statement of GEMS Limited prepared for the year ended 31st March 2025. Okay, now you have this situation here. This is the relevant items for cash flow statement. They said redraft and reconstruct the cash flow statement of GEMS Limited in proper order for the year ended 31st March in accordance with AS3 using indirect method. Okay. Now, first thing is what? Net profit. That is your starting point. Net profit. Can you see 75 lakhs? Okay. Now, sale of investment 87 lakh 50,000. Sale of investment. Where will you put the sale of investment? Directly we'll put it to investing activity. 87 lakh 50,000 investing activity. Clear? Next, depreciation on assets that you are going to add back. 13 lakh 75,000 depreciation you are going to add back. Next, issue of preference shares. Issue of preference shares will go to financing activity. Go to financing activity and write 11 lakh 25,000 issue of preference shares. Next, loan raised. Loan raised is loan borrowed. 5 lakh 62,500 loan borrowed. 562,500 loan borrowed. Next, decrease in stock. stock decrease, 15 lakhs, stock has decreased. So working capital changes, you are going to show 15 lakhs. See, decrease. Sorry, that is not the one. This is the one. 15 lakh. Stock decreases, profit increases. Profit doesn't increase, it's just working capital changes, reversal. Yes. Purchase of fixed assets, investing activity, outflow. Decrease in creditors, creditor decrease, you have to show minus only 7,50,000. Okay, next. Increase in debtor, debtor increases, cash, you have to show minus 10 lakhs. Exchange gain, what you are going to do? You are going to add it back 10 lakhs. Sorry, gain, you are going to subtract it 10 lakhs. Non-cash item. Profit on sale of investment, subtract 15 lakhs. Profit on sale of investment. Redemption of debentures. Redemption of debentures should go into financing activity, 7,12,500. 7,12,500. Dividend paid, 1,75,000. Dividend paid, 1,75,000 minus financing activity. Next, you have interest paid. Interest paid is also financing activity, 1,18,125. Okay, so it was there. Cash flow was there. Only thing is it was not drafted in the correct order. So we have redrafted the cash flow statement. This should be it. With December 2025 set 1. Now December 2025 set 2. We'll see if there is a cash flow statement question. No. No cash flow statement question in set 2. With that, we are done with cash flow statement. So I have discussed the chapter 1, chapter 2 and chapter 3 in detail. Okay, now banking, insurance and all, I'm not going in detail. Standards also, only conceptually I'm going to touch on that. Clear? So the remaining chapters, some of the key concepts I'm going to touch on. Okay, let's quickly go into that. Financial statement of banking companies, regularly asked. Some concepts I'm going to touch on. Okay, balance sheet and P&L, two things are there. Now there is a reserve fund, which is an important topic there. Statutory requirements, a statutory requirement, that is every banking company is required to transfer minimum 25% of the profits earned during the year. So whatever profit the bank is going to earn, right, when you're preparing P&L, whatever you get, 25% you transfer it to statutory reserve, that is reserve fund. Clear? Bank. Even if they don't tell in the question, please do this because otherwise they'll cut marks. Now bank, loan given to customer is an asset for the bank. Loan borrowed, okay, loan borrowed is a liability. Savings account, current account, whatever is there, that is also liability. Fixed deposit by customer, that is also liability. Correct? Interest on loan. Interest on loan, understand, if loan is a performing asset, that means people are paying the money on time, performing asset, then loan account debited to interest account. Loan account is debited because it is receivable, due entry increases, asset increases, and interest is an income, so income credited. When you get it, cash account debited to loan. When you get it, what will you do? When amount is received, cash account debited to loan. Now see over here, if loan is a NPA, if loan is non-performing asset, then due entry you don't pass. What you do is loan account debited, increase the loan, but you put it to interest suspense account. Why you are calling it as interest suspense? Because we are not sure whether we are going to get the money or not. When amount is received, cash account debited to loan account. Cash account debited to loan account. Then what will you do? Recognition of interest. Remove. Now you got the money, right? It's an interest, right? Interest suspense account debited to interest account. Interest suspense to interest account. This is what you're supposed to do for interest treatment if it is performing asset and if it is non-performing asset. Acceptances and endorsements and other obligations. Now, it is liability of the bank. Accepted by the bank on behalf of the customer. So it's liability. Example, bills accepted by bank on behalf of customer or LC shown as contingent liability in the balance sheet. When you prepare balance sheet, show it as contingent liability. Rebate on bills discounted. Rebate on bills discounted. Customer discounts bill with the bank. Customer is discounting the bill with the bank. Bank charges this discount as income. Okay, they charge they charge the discount to the customer, but for the bank it is income. If bills are maturing during the year, income of current year. But if part of the duration of the bill falls into next year, if imagine 3 months are there, 2 months are falling into this year and 1 month is falling into next year, it should be treated as rebate in the current year. It should be treated as rebate in the current year and treated as income in the next year. So understand this. Current year, what we will do? Interest and discount account debited. Remove the interest and discount and put it to balance sheet as rebate on bills discounted. This is a liability, income received in advance. Next year, what will you do? Rebate on bills discount debited. This year, it's not this year's income, but next year it is next year's income. Rebate on bills discounted account debited to interest and discount account. Now, rebate will always be bill amount into rate of discount. That will be given in the question, into number of days falling into next year. Number of days or months or whatever it is which is falling into next year, divided by 365 or 12. If it is days, divided by 365, or if it is months, divided by 12. Clear? This is it. Next, we are going into classification of assets and provision creation. Classification of assets and provision creation. Now, understand this. If it's a performing asset, asset with normal risk, asset which has normal risk, then you create 0.4% provision generally. Okay, but if it is agricultural and SME sector, 0.25% is enough. Okay, if it is real estate sector, 1% provision you are going to create. Clear? Now, NPA. First 12 months of asset being classified as NPA, it is called as substandard asset. First 12 months when it is classified as NPA, it is called as substandard asset. Okay, 15% if it is secured and 20% if it is unsecured for infrastructure and 25% unsecured for others. For infrastructure 20%, for others it is 25%. Clear? Now, doubtful assets, after 12 months of assets being classified as NPA, that it is called as doubtful asset. Doubtful asset, what is going to happen is, okay, secured up to 1 year doubtful, 25% provision. Okay, 1 to 3 years doubtful, 40% provision. Greater than 3 years doubtful, 100% provision. If it is unsecured, 100% provision. If it is unsecured, 100% provision. Clear? But if it's a loss asset, what is a loss asset? Loss asset means we have already, the asset has been termed as loss asset. That means the internal auditors or someone has told that, boss, you're not going to get the money, write it off. Now, if it is a loss asset, nothing to worry, 100% provision you're going to create. Now, see over here, doubtful assets, if it is secured only, you have these timelines. If it is unsecured, 1 to 3 years are, more than 3 years are, less than 1 year are, you don't have to worry, 100% provision if it is doubtful. 100% provision if it is unsecured. Clear? Now, ECGC cover, that is Export Credit Guarantee Corporation. DICGC is Deposit Insurance and Credit Guarantee Corporation. These are covers given by government for banks to cover their risk. Provision needs to be created only for the uncovered portion. So, if there is some doubtful asset, if there is some assets with the bank, okay, remove that ECGC cover, then whatever is there, then you classify substandard or doubtful or whatever it is you do. Only for the balance portion, provision needs to be created. For this, already government has given us guarantee, okay, that they'll give us the money in case something goes wrong. Clear? Now, accounting standards, we'll go into accounting standards and discuss the accounting standards. Okay, Ind AS 2, inventories. Now, inventory can be what? Stock, which is raw material, which has raw material held for use in production. We are using this raw material for producing goods, okay, which is a current asset. Now, we can also have work in progress, that is semi-finished goods. And we can also have finished goods, completed product held for sale. That means we are waiting to sell it, but we did not sell it yet. Now, current asset, when we are talking about, we have balance sheet. It will go to balance sheet, okay, as inventories. And in P&L, we already saw multiple times it will go to changes in inventory. Okay, that is what you have to understand. Not applicability, non-applicability. What is not covered under Ind AS 2 as inventory? Financial instruments, that is shares, debentures, all that is not covered because it has a separate standard for that. And biological assets, that is livestock, animals if you are having, that is not covered. And agricultural products which are there, that is also not covered. Valuation of inventory will always be at cost or NRV, whichever is less. NRV means what? Net realizable value. Now, how will you calculate cost? Cost of purchase price. Okay, purchase price, whatever you decided to pay, but you got discount, minus. Freight charges, transportation from there till here, add. Duties and taxes, what you have to pay to government to release the goods, add. Loading and unloading, also related, add. Transportation in by road, carriage, that also add. Any other expenses to bring the inventory to its present location and condition. Anything else you have spent to bring the inventory over here, that also will be added. This is your cost of purchase. Clear? Exclusion from cost. Abnormal loss is not included. It is going to go to P&L as other expense. Administrative expense is not required for this. It's an indirect expense, goes to P&L. Selling expense also not required. Storage and packing expense also not required. All this will be transferred to P&L. Clear? Now, cost of conversion, okay, is to convert the raw material into finished goods. What you are spending, that is called as cost of conversion. You have direct material, direct labor and overhead. all this direct material, direct labor and overhead, variable overhead, all this will be given per unit. Directly it's easily possible, and all these are variable in nature. Fixed overhead you have to calculate. Refer to the note. Okay, this is considered as cost of conversion. Now, note for fixed overhead. See, usually computed on the basis of normal capacity. Normal capacity means what? What you have actually planned to use it for. Okay, imagine you took a room. Okay, you took a factory. Factory rent what you're paying, it is usually based on normal capacity. If actual production is equal to normal capacity, then total cost divided by normal capacity, total cost you will do divided by normal capacity, you will get the fixed overhead per unit. If actual production is less than normal capacity, if actual production is less than normal capacity, still you will do total cost divided by normal capacity, you will get the answer. But if actual production is greater than normal capacity, that means it is overabsorbed. It will become overabsorbed if you divide by normal capacity. So therefore you will divide by actual production. Clear? And you are going to use the methods of FIFO or weighted average only. NRV, net realizable value. That means what can you get from this inventory? Estimated selling price of finished goods minus estimated cost of conversion minus estimated selling expense. That time you will get your NRV. Now, joint cost. Joint cost means what? Till a particular, you have studied this in costing. Till a particular point, it is together. Then it is separated into two separate products. These are called as, this is called as point of separation. Cost incurred on joint products till separation point. Cost incurred on joint products till the separation point is called as, joint cost. Split it off in the ratio of sale value. Whatever the sale value, not selling price per unit, sale value, that is selling price into number of units, whatever sale value is there, in that ratio you apportion it. Byproduct is wastage. If it has a market, net realizable value of byproduct, reduce it from the cost of the main product. It's easy, right? You're getting some money, simple, you're very happy, reduce it from the cost of the main product. Valuation of raw material. Remember, if finished goods are sold at cost or finished goods are sold at above cost, that means good raw material is valued at cost or NRV, whichever is less. If finished goods are sold at or below, finished goods are sold at below cost, that means you're selling the finished goods at loss. Raw material will be cost or replacement cost, whichever is less. Now, India has 10 events after reporting period. After reporting period. Reporting period means what? Balance sheet date. Events after reporting period means any events that is occurring after reporting period, but before the accounts are finalized by the board of directors. After reporting period, but before the financial statements are approved by the board of directors, whatever time period is called as events occurring after reporting date. For example, see over here, our balance sheet date is 31st of March. Board of Directors finalized it on 31st of May, audit completed on 31st of August, and AGM is held over here 30th of September. We don't have to worry about all these dates. Between the reporting date and date of finalization, whatever is happening, that is called as events occurring after reporting period. We have adjusting events as well as non-adjusting events. Adjusting event means what? Situation already existed on the balance sheet date. I got more information or evidence received about it after the balance sheet date. If it is an adjusting event, adjust it. Adjust what? Adjust means what? Change the assets and liabilities on balance sheet date. Pass an entry and make the adjustment. If it's a non-adjusting event, that means situation did not exist on the balance sheet date. It's an entirely new event. For example, maybe fire to the go down, entirely new event. This was not there on the balance sheet date. Okay, what you're going to do, don't adjust it. No entry. You still want to tell, you feel like telling the reader, okay, fact may be mentioned in the board's report. Fact you will mention in the board's report. Now, exception to the rule is there. If non-adjusting event affects the going concern rule, that means if because of it's a non-adjusting event, but going concern is affected, that time adjust it. Even though it's non-adjusting, adjust it. Clear? Now, dividend is a non-adjusting event, recognized only when dividend is declared. Okay, and paid. Now, accounting for electricity companies. Now, some important topics of electricity company we'll just see. Accounting for security deposit. Electricity board collects it from consumer. Electricity board is collecting the security deposit from consumer. In case of non-payment of further bills, amount will be adjusted against the deposit. If they don't pay, that time the deposit amount will be adjusted. Now, the journal entry on receipt of security deposit, bank account debited to security deposit. It's a non-current liability in the balance sheet. Because we have collected the amount, we are going to pay it back. Whenever they ask, we have to give it back. Interest accrued on security deposit, interest expense account debited. Okay, interest expense account debited to interest accrued on security deposit. Why interest expense? Because we have to pay money on this security deposit to the customer. Okay, adjustment of interest with consumer bill, interest accrued on security deposit to sales turnover. So what we are going to do, the interest expense, what I'm supposed to pay you, that I'm adjusting with the sale which I have made to you. With your electricity bill, this interest is adjusted. Clear? Now, depreciation computation. Compute depreciation as per prescribed rates. Compute total depreciation except the owned land. Land, no depreciation. Compute total cost except the owned land. Again, for land, you don't have to value the cost and all. Weighted average rate of depreciation is total depreciation divided by total cost into 100. Computation of ROE. Check the table in the concept book. We have the concept book there. We have already discussed in detail. I'm not going to discuss it in this marathon. Okay, rates of depreciation is also there. Now, gross opening capital, whatever you find gross opening capital, on that 30% of capital expenditure approved. Okay, additional capital is 30% of capital expenses. Now, this we have to understand this formula. Okay, gross opening capital. What is gross opening capital? 30% of capital expenditure approved and additional expenses 30% of capital expenditure. Format for statement of interest on working capital to be computed. Refer format. Also refer the concept book. I'm not going to do that in the marathon right now. Accounting for insurance companies. We have life insurance or we have general insurance. Important concepts. Premium. Payment by insured, the customer, to the insurance company to cover the risk. Claims. Payment by insurance company to the insured in case of damages to compensate. Commission. Amount paid by insurance company to the agent for getting the policy. Getting this business, we are giving him commission. Surrender value. Amount paid by insurance company to insured on surrender of policy. If they don't want to continue with the policy, whatever when they give the policy back, we'll give them some nominal amount, that is surrender value. Okay, paid up policy. Paid up policy is nothing but a formula. Sum measured into number of premiums paid divided by total number of premiums payable. This is called as paid up policy. Reinsurance means what? Insurance company giving it to some other insurance company. One insurer insuring the risk with another insurer, like subcontract. Okay, double insurance. Insured under more than one insurer. You have taken double insurance so that you are covered. Okay, life assurance fund. Fund accumulated by the insurance company is called as life assurance fund. Reinsurance ceded. Reinsurance ceded means we have reinsured with another insurance company. Insurance company has reinsured with another insurance company. Reinsurance accepted means one more insurance company has given us the reinsurance. So another insurance company has reinsured with us. Clear? Now, valuation balance sheet. Okay, just have a look at it. 95% of the profit of life insurance business must be distributed to policy holders by way of bonus. Balance 5% to be utilized as determined by government. Right now, they have not told anything. Unexpired risk reserve means what? Provision created for possible future claims. So, unexpired risk reserve means this year nothing happened. He paid the premium only. That's it. But next year something can happen. You're creating a provision for that. I will go into India's 19. Employee benefits. Employee benefits, what is going to happen? Consideration given by employer to employees, employees' spouses, employees' children, and employees' dependents. Okay, or to trust which employee has told, or to another insurance company on behalf of employee. All this will be considered as employee benefit. Employee benefits includes payment under formal plan or agreement. Formal plan or agreement, that means in your offer letter, whatever is there between employer and employee, under legislative requirement, that is PF, gratuity, whatever they are telling to pay, that also you have to pay. Informal practice. Last year he gave a sweet box on Deepavali day. So this year also the employee will be expecting the sweet box. That's why which creates expectation among employees. Informal practice also is employee benefit only. Excludes only one thing, that is ESOP. ESOP is not covered over here. Now employee, when we go to employee, who and all is included in employee? Basically everyone. Includes part-time as well as full-time employees. Includes formal and informal employee. Includes whole-time director. Includes who? Whole-time director also. Everybody is included. Only whole-time director, normal director is not there. MD is not there. Now, types of employee benefits. We have short-term employee benefits, which is expected to be settled within 12 months. That is wages, salary, leave salary, bonus, etc. Then we have post-employment benefit, retirement benefit, that is pension, gratuity, etc. Long-term employee benefits are long-term disability benefits like sabbatical leave and all. If you want to take a break for mental health issues, okay, that time we will give you some leave. That is long term. That is only if you complete 3 years in our company or 4 years, whatever the time period might be. Termination benefits is VRS or retrenchment compensation. Now, accounting treatment. Short-term employee benefits shown as expense in P&L under employee benefit expense. Okay, if it is unpaid, then shown as current liability because outstanding salary. If it is paid early, shown as current asset because it is prepaid expense. Leave salary accumulating. There can be two types of leave salary. One is accumulating, one is non-accumulating. Accumulating means, non-accumulating means what? Leave cannot be carried forward. I gave you leave this year, you take that leave. If you don't take it, gone, lapsed. Okay, accumulating means leave can be carried forward. Once the leave is carried forward, you have two types again, vesting or non-vesting. Vesting means what? Cash can be taken by employees. Okay, that means whatever leave you did not take, okay, it is carried forward, you can take cash. Non-vesting means no boss, you can't take cash and all. Cash can't be taken, you have to take leave only. Okay, make provision for any bonus to be made. Okay, any bonus is there, make a provision. You know you have to pay bonus, make a provision for this. Accumulate accounting for post-employment benefit. In post-employment benefit, you have two types: defined contribution plan and defined benefit plan. Defined contribution plan means employer pays fixed contribution to a separate fund and will have no further obligation to pay any amount to employees. Like when we make the PF contribution, over, no, done, no, we have made the contribution to Provident Fund. Now Provident Fund has to pay the amount. We don't have to worry about anything. Defined benefit plan, employer has agreed to pay directly to employee on retirement. I am only telling when you retire, I'll give you this. Okay, employer will make planned investment to save money to pay the employees. Now you have to save money so that you can pay money to employees. This is called as planned investment. Also, it's called as plan asset. Plan asset. Now, if defined contribution obligation is greater than fair value of plan asset, that means your obligation is more, plan asset is less, that will be taken as non-current liability. If your contribution is less, plan asset is more, that means your assets are higher than what you are supposed to pay, non-current assets. We'll go into earnings per share. Okay, we have EPS, basic EPS and diluted EPS. Basic EPS is given by this formula, Patesh divided by 1s. Okay, Patesh means what? Profit available to equity shareholders. Whatever profit is there to equity shareholders after paying the preference shareholder. 1s is what? Weighted average number of equity shares. Okay, diluted EPS is to be computed when there are potential equity shares. Potential equity shares means what? Today they are not equity shares, but in future they can be converted into equity shares. Okay, that is convertible debenture, convertible preference shares, options which can be converted into equity shares in future. Diluted EPS is basically Patesh only plus savings from conversion. If you convert debentures, you don't have to pay interest, that is a saving. If you convert preference shares, you don't have to pay dividend, that is a saving. If you convert option, actually there is no saving. Divided by 1 is plus increase in shares due to conversion. When you convert preference shares, options, debentures, there is some extra shares which is coming in for free of cost, that is going to be added. Method to compute EPS when right shares are issued. Right shares are one topic which can be tricky when EPS is there. Now, first what you're doing, basic EPS will be Patesh divided by 1 is before right issue. Whatever weighted average number of shares we had before right issue, that into right factor plus 1 is after right issue. Now, how to get this right factor? Fair value per share before right issue, which will be given in the question. What is the market value per share before right issue? Divided by theoretical ex-right fair value per share. Theoretical ex-right fair value per share is what we already calculated once. Okay. Number of shares before right issue into fair value per share before right issue plus right shares into right issue price. The whole thing divided by total shares after right issue. This you put it over here, you'll get the right factor and you use the formula, you'll be able to calculate the basic EPS, correct? Now, Ind AS 37, provisions, contingent liabilities and contingent asset. Now, provision to be recognized if following conditions are satisfied. If you fulfill the following conditions, it will be considered as provision. When entity has a present obligation, there is a present obligation as a result of something that has happened in the past, as a result of past event. It is probable that outflow of economic resources is required. That means because of that obligation, it's probable that you have to pay money to somebody or some resources are going out. Okay, reliable estimate can be made of the amount of obligation. You are able to estimate the amount, then you can take it. Now, you go further. See, that means there should be an obligation that should lead to outflow of resource, and that outflow amount you should be able to estimate. This much only I might have to pay. If you are able to estimate, good. Contingent liability. Probable obligation, no present obligation, probable obligation as a result of past event. It is probable that outflow of economic resource is required. Reliable estimate can be made, but you are not sure whether you have to pay or not. Probable. Or there is a present obligation as a result of past event. There is a present obligation. Outflow of resource is not probable. We don't know whether we have to pay or not. Or reliable estimate cannot be made. You have to pay, but you don't know how much to pay. In such cases, it becomes contingent liability. Now you go into contingent asset, where a possible inflow of economic resource can happen in future. That means there is a possible asset as a result of past event, which can happen in the future. We don't know. Happening or non happening is not under our control. We'll get to know in the future only. Okay, that's it. This is our very brief marathon on corporate accounting, guys. Easy questions are asked in the exam. Okay, do not neglect those questions. Just go through all the things, all the past examination papers and model test papers. I'm sure you all will come out with flying colors, and we'll meet again in CMA final. All the best, guys. See you.